All right, we are back. Let us know if you can still hear us and see us. You should now be able to see us as well. Vince has given me a budget for prizes for this event. Vince, thank you for that.
See, like the markets, there are unexpected events.
Yeah, this is certainly a black swan event. All right,
News to
so
me, but that's okay.
our first prize,
No, that's fine. Yeah, let's give away some stuff.
is the book by Ray Dalio called Principles. You've read it though, haven't you? You've read it before, Vince?
Yes.
Okay, like the book?
Love it.
Okay, all
Love
right.
it.
So there is a question that you
Love
have
his
to
stuff,
answer.
all his stuff. I would encourage anyone to go out and read all of Ray's stuff.
All right. So we are giving away the book. You can have a hard copy, or if you, I think maybe we may be able to gift a Kindle version to you somehow, some way now with this technology. So the question is, you have to earn this. What is the best performing stock in the Dow 30 year to date by percentage terms? In percentage terms.
All right, get those Google searches going.
We're using the honesty principle here, so we cannot Google it. Amazon is not correct, Gregory. In the Dow 30.
Okay, we have Apple, we have UNH.
All right, who said Apple at 11:32? All I can see is Trader from Los Angeles. Who put Apple in? I do have a UNH. UNH is not correct. Ramesh, was that you with the Apple?
There you go.
All right, Ramesh, it is. Ramesh, if let us know you can put your address in the chat box here. Only I will see it, and we will send you out a copy of the book. All right, the next giveaway will be for a lovely, very lovely cross rollerball pen. That's going to be nice. No, Vince, you cannot enter.
I love pens. Come on.
I know you do. I know you do. All right, so we talked a little bit about trader psychology at the beginning, state of the markets. You wanted to now talk about how to manage watch lists and keeping a trading journal as well.
Yeah, I want to show you how I do this. We'll just take a few minutes and do that. I think it's really important. I think it's easy to get overwhelmed, for lack of a better word, looking at too many lists, too many stocks. There's so much out there. It's tempting. I still do it. I still look at way too much. I should narrow my focus, but I'll let you look over my shoulder here and see how I do things. Okay.
All right, let's get started.
Okay, so I'm just going to turn off my camera here, so I'm not distracted. There we go. Okay, so for this, I am going to bring up a different platform. If I can find it here, there it is. All right, so this is my Trading View platform. Now, try not to focus on the charts here. This is what I call my testing ground. So without revealing anything here, this is an ongoing process where I test theories, ideas, different combinations, and I do share some of this stuff with my one-on-one coaching clients. But just to give you a brief idea, I put different looks in the windows. So here, this is just a chart of the SPYs, right? And the top left chart is a daily chart. The top right is weekly, top left is monthly, and then bottom left is monthly, and bottom right is again daily. So two different looks, top left and bottom right are both daily charts, different indicators, different types of candlesticks. Here on the bottom right, they're just regular. Up here, they're Heikin-Ashi. There are reasons why I want to see a different snapshot of this as I go through my trading. But this is all stuff that I'm testing on an ongoing basis to make our systems better. And so I don't want you to focus too much on that. I want you to focus on the right here, on the right column. Now, this is where the watch lists are. And what I like to do here is have a number of different watch lists, but I like to start with what I call the basics, which for me are the main index charts. So like the Dow 30, for example, it'll be the 30 stocks in the Dow, right? That's it. So at any point in time, I can just go over, click on one. I'll get that different picture here for what I'm looking for, what I'm trying to assess. And with my arrow key on my laptop, I can just quickly scroll through one at a time, and I'll go through 30 stocks in no time, right? A couple of minutes and it's done. I'll have the same thing for the NASDAQ 100, for the S&P 500, and for the Russell, okay? Aside from that, I do like to break down, for example, and look at some currencies, Forex, and it'll just be a few of the main pairs. So whenever what you want to get to is basically for every sector or for every index, or whatever it is you're looking at, try to narrow it down to the most active issues, or the ones that tend to set up more often, or just have a strong trend in place, etc. So these are just a few of the currency pairs that I'm following now. I do like to follow the IBD 50. So for those of you who may not be familiar with it, Investors Business Daily is a newspaper run out of California, out of LA, and it's one of the best business papers out there. But they publish a list, their top 50 stocks. Now, the way they rate them is not based on technical analysis, it's based on fundamental analysis. So what I like to do is just take those 50 stocks, throw them in a watch list, right? And I know that from the methods they follow, they're sound from a fundamental perspective. And now I look for opportunities on, using technical analysis to gain an entry point on those. And most of these trend very nicely and present many opportunities along the way. And you get some really nice trades out of these. And so that is a list that I always carry, the IBD 50. So if I'm ever pressed for time, right? Let's say I have a function to go to one night, but I just want to quickly run a search. Yes, with the indicators that we have, like our winning momentum strategy, our veracity on Metastock, Tactical Trader, etc., I can just quickly bring up the scanner, run a quick scan, and see what comes up. But I have my go-to list, like the IBD 50, that I will scan, right? And you really only have to update this once a week, not daily. So it's very quick and easy. So I like doing that. I have a few others like the main ETFs that I follow, right? So you have your main index ETFs, like your SPY, your Qs for the NASDAQ. Then you have your different sectors, like your energy sector, financials, technology, etc. And then your FX, right? Your currencies, okay? The Aussie, the British pound, the Canadian dollar, the euro, Swiss franc, your Japanese yen, etc. Just quick ETFs. So again, when I'm pressed for time, I can just quickly scan those, and I'll get an idea of areas to focus, right? So for example, if I see a setup on the technology ETF, I know where to look, right? I know I'm going to go to the FANG stocks, for example, and look at the Googles of the world, and the Amazons and the Apples, and all of those, right? If I'm going to financials, I know I'm going to go look at the banks, and so on. So you don't have to look at every stock out there to find a few trading ideas. They're all over the place. Okay. And then what I like to do here, you'll see red list and green list, because TradingView gives you the opportunity. If you look to the left of a symbol here, if I click, there's a little flag here, and I can give it a color. So if I see a bullish setup for example, I'll flag it green, right? If I see a short setup, and this one doesn't have a short setup, but let's say it did, I'd color it red, okay? And if there's something that, looked like it was about to set up, but isn't quite there yet, but I want to just flag it so I know in the next few days I want to look at it, I might put it like an orange flag just to say, okay, that one I'll come back to, right? And then what I do is I separate them. I move them to those lists so that when the market opens the next morning, right? If it looks like we're opening higher, the first list I'm going to go to is the green list, right? And I pick the green list, and I'm going to quickly scan through, what it is I might want to trade that day, right? Might want to look at for an entry. Now, this isn't up to date. These are just old symbols I left in there this week, and I will update this, right? If the market's going to open short, I'm going to look at some red setups. Now, the exercise you want to do, if you have the time the night before, is let's say you have 10 or 12 candidates in the red list. You want to go through them, but then you want to rank them, right? It's like a to-do list. You want to prioritize, right? So if I think GWW is, a better short than CPA, I want to move that higher, right? I want to move that to the top of the list, for example, right? And then SMH is the next strongest, and so on. So from top to bottom, right? And as I go through the process, when I take a more detailed look, I will eliminate some of these, okay? Same thing as you want to have a list. So if in general, for example, let's say they're not setups, but let's say there's some cannabis stocks that I want to look at because that's the hot sector right now, right? It'll fall into what I call a new trade idea, for example. And I put a few in there where I might have an idea for an upcoming trade, but it's not quite there yet, okay? They may have colored flags if those setups have come together or not, but they're just a short list of some new ideas that I want to look at. But the other thing I would suggest is then you have an open trade tab, okay? You have one for all your open trades so that you can just go in there and quickly every day go through those, right? At the end of the day and say, how is this doing? Is it time to adjust? Is it time to sell? Or do I just hold, and so on? You always, whenever you purchase a stock or short a position, you want to add it to your open trade list and always have it handy there so you can quickly scroll through. That's how I manage my watch list. Okay. Any questions on that at all?
Sandy was asking if you only scan Heiken Ashi charts first.
No, I don't. No, I don't just scan. Heiken Ashi is one thing that. So here's where we get back to trading what suits you, your style, and this is where I'm going to be different from many of you. I have to do what works for me. So, for example, I have been scarred many years ago. I took that sizable loss, and that scar lives on. And so I know for myself that once I open a position, okay, and I'm in it for a while, in order for me to be able to remain in that position and not get scared out of it, I want to use something that's going to convince me that the strong trend is still in place, for example. So there's a couple of different ways I do that, and I'm jumping ahead to the technical analysis side, but here's a couple of things that I do that might work for you as well. So I put on what we call a moving average ribbon, which all these green lines, I'm not sure if you can see it well. Maybe I'll just I'll go to one chart so you can see it better. Does everyone see these green lines? Now you can color them differently, but they're just a series of moving averages, like a 10, a 20, a 30, a 40, a 50, 60, 70, 80 kind of thing. The reason why I have them there is because when, you know, they sort of cross over, all right, when they're not in the proper order, that's telling me to stay away, okay? But when they're stacked appropriately, like the 10 over the 20, 20 over 30, 30 over 40, etc., then that's when you know that there's a strong trend in place. And the wider the gap between each one, okay, the stronger the trend. So when I see an area, you know, like this, for example, you get this pullback, this retracement, but you see all these moving averages, not only are they stacked appropriately, but there's a clear amount of space in between each one. We know there's a high probability that this is just a minor pullback before a continuation of that move. Now, I use it first to try to find that turning point, even though I have other methods, as you know, like the cross of the RSI and all those things. But if I identify that entry, okay, and now I'm in this trade from here, Heiken Ashi candles don't allow you to see those minor, you know, those down days, those red candles along the way. It just shows you that the trend is ongoing. Now, you know, with all four looks, I'm going to see it on this chart, right? I'm going to see if there was a pullback over here somehow, right? But it just it allows me that extra comfort in knowing that, hey, the Heiken Ashi is still saying this thing is trending strongly. So there's no need for me to panic. I'm in good hands here. Got the Heiken Ashi strong. I got the 20 strong. I got all these moving averages stacked appropriately with space. You know, I'm stacking on the evidence to say, hey, maybe you should just relax and let the trade play out a bit more. That's the way I do it. Okay, you don't have to do it. You can do what works for you. But that's why I have the different looks. And I also like to follow it for a while to see if there's something about the Heiken Ashi that will tip my hand to an upcoming trade before I would actually see it on a plain candlestick chart, right? And vice versa. So that's why I have the different looks. Every day I'm studying this stuff. Every day I'm researching for new things. And so you need to have them on your chart for a while to be able to spot those differences. Okay. Any other questions?
Tron in, I'm not sure where Tron is from, but excuse me, asking how many years before you were consistently profitable?
Well, it took a while. Now, I can't say my focus was strictly on my trading the way, you know, it has been over the last several years, because I used to work professionally for one of the major banks and trade for them. So it's not the same thing. But for me to make a living at it and you know, having left my job and just doing that, well, I'd say it probably took 10 or 12 years. It took a while. It took a while. I wasn't born the trader I am today. It took a while, a lot of studying, a lot of hours reviewing charts. It's a process, and I'm still learning, to be honest with you. Again, I don't know who that is. It says Trader Los Angeles, but says Vince, I only use Heiken Ashi charts with guppy multiple moving averages, which are the EMA 3, 5, 8, 10, etc. Do you have any thoughts on that? I think it's great. I think the fewer things you have on your chart, the better. Now, that may sound like I'm contradicting myself based on what you see here, but again, this is a testing environment. I'm going to show you later how you can do everything you need to with just one moving average, right? So whatever works for you. I think I like the guppy multiple moving averages. Love them. Have used them in the past, and Heiken Ashi. So it's just a matter of you focusing on what works for you. The simpler you can keep it, the better It is. This is the Trading View platform, by the way. You're going to see Thinkorswim today. You're going to see Metastock. You're going to see Trading View. Yeah, I use a number of them.
That was our friend Spiro asking about the Heiken-Ashi and Guppy.
Oh, yeah. Spiro's been with us for a while. Great question. And yeah, fantastic. Stick to what works.
All right, let's keep moving.
All right. So aside from these, it's how you track what you do. Now, the trading plan is the trading plan. You have to decide for yourself what strategy you're going to use, whether it's Heiken-Ashi and the Guppy multiple moving averages, or whether it's something like Veracity or a combination. Once you decide, you want to put together your list of rules, okay? And you're going to say, these are the things that must be in place before I enter a trade, whether it's long or short. And you might have a list for the longs and a list for the shorts, but you want to make it, and I've said it in the past, you want a checklist. And you want to be able to check off those things, one or the other. So when you look at your list, when you sit down to trade, if not all the boxes are checked off, then you don't have the right to place that trade, okay? Because then when you go back to do your review, if you go back and you say, well, why did I lose $1,000 on that trade? And there were 3 boxes that were unchecked. Well, there you go. That's why you lost, right? It's kind of obvious. So it's almost like having someone there keeping you accountable to say, all boxes are checked. Yes, go ahead and place your trade. They're not all checked. Stop and reassess. Okay. But one of the ways I do that is I keep a trading journal, like I said. This is the spreadsheet I keep. Now, again, if you want a copy of this, we're happy to send one out to you. Okay, we just need to know that you want it. So, Raul, I don't know what you think is best, an email or that'd probably be best, right? Because it's probably hard to know who everyone is here if they hadn't put their name in, right?
I can just I can drop it in as an attachment here.
Oh, okay. Well, I'll have to. Yeah,
I've got it. I've got it.
You've got it, but I don't know if you have all these different tabs. But anyway, you can create your own here. Okay, so great. Raul, we'll put it in as an attachment. Take it, save it on your computer, and then if you want, just add these tabs, and I'll show you what they are. So you're definitely going to have the first one, and I just want to explain here what this is. So the gray boxes, right, are the ones you have to fill in when you initially place a trade. The yellow ones are what you change nightly as the trade progresses, what you might want to update, the yellow columns. The green is just a formula that's already in place. Those will be filled in automatically by the formulas, okay? So basically you're entering the symbol, whether you're going long or short, the date that you purchased, the average fill price, and every night you update the new close for that position so that it can update whether you're losing on that position or gaining and so on, and the current stop level. So if you're trailing it, for example, this will change on a nightly basis, right? Your original stop was the one you placed when you placed that order. Now, this is slightly different if it's a stock compared to an option, right? Because you can use the actual stock price or you can use the option level. So for example, if I paid 31 cents for an option, let's say, and my stop is if it gets to 20 cents, I'm out. This is just a weird example. These aren't actual trades. This is just an example, okay? Then that's your original stop level. And then let's say it moves up to 80 cents and now you want your stop at 60. That's what you're going to change from night to night, right? It'll populate your risk per share or option. You're going to have a first target, a second target, etc. And again, ignore, these aren't real numbers. They're just thrown in. These next couple of columns I want to explain, the bracket order set and the alert set, yes or no. These are ones that I customize my sheet with, meaning there was a time where I would only allow myself to place a bracket order. A bracket order is when you enter your position and you put in a sell profit order at the same time as your stop order, okay? That way you can walk away and let the market do its thing. And one of two things is going to happen. It's either going to hit your profit order first, which will sell your position and immediately cancel the stop order, or it'll go against you, hit your stop order, it'll sell your position and immediately cancel your take profit order, okay? And I just want to put this as a reminder to say, did I do this or not? Yes, because at that point, I was thinking I want to only use bracket, or I want to force myself. So I'm going to have to see a why here. The alert is to put an alert on the price level of the stock to say, hey, if it drops below this level, I want an email or a text message to say, you got to look at this position, okay? So again, you can remove these if you don't want, or you can keep them in there. And then, you know, the other thing is news. Every night, was there new news on the stock, something I should worry about or not? Yes or no? And comments, and it can be anything. This is the area where you can make comments for what you're looking for. Like, you know, the momentum on the stock is slowing down, consider selling it sooner than later. Or this is where you can keep track of your feelings. Like, I was very nervous putting on this position. You know, I'm about 50% confident of it, 80% confident of it, whatever. Or this is where you also update after the fact when you sell. And you can say, looking back, I exited too soon. I got scared out for this reason. I should have hung on for this reason, and so on. Now, here's the second part to this. These are your open trades. The current tab, these are your open trades. If you scroll down, you get to historical, which is where once you close out a trade, you move it from here. You copy and paste it, and you move it down to here. And this is where you would place those comments as to, you know, why I got out when. Maybe I followed it perfectly, and you can put it in there. My stop was hit. You know, I did the right thing. I sold when I was supposed to. Move on to next trade, right? So your current open trades, your closing trades, so you can keep track after of the profits and so on. And at the top here, this profit to date is a combination of the current unrealized gains or losses on your open positions, along with your historical profits or losses. So it's a combination. So at a snapshot up here, you'll see what, you know, whether you're making money or losing money going forward. Now, there is a field where it'll explain each tab to you, but I have other fields here. First of all, trade checklist. Again, this is not my current trade checklist. This is not everything I look at, but this is all stuff I've considered in the past, and you can shorten it, lengthen it, whatever you want. This is exactly where you put what you need to see before you enter that trade. So if you're trading with our WMS system, for example, you want to say, you know, stock and moving average above cloud, right? You want to say 20 period moving average sloping higher, RSI 7 crossing above 50 line, right? You want to put the things that you want to see before you place a trade, so that this, in fact, is your checklist, okay? And you can come here and just put yes or no, yes or no, yes or no, right? And make sure that you're following. It's always there, one click away for a reminder. You don't have to try to memorize anything, okay? I like to have a tab for adjustments, things to remind me. And again, you don't read what's here. It really does. This is all old stuff. It's just a matter of, if the stock gets to this position, you know, how am I going to adjust it, right? So if I bought the stock and I had a married put on it and it moved higher, now do I want to consider selling a covered call against the stock and bring in more premium, that sort of thing. Just ideas for you to adjust it along the way. There's also for those of you who are a little more aggressive, what I call a progression trading tab. So for example, sometimes I will take a small amount of money, say a portion of a profit I made on a trade. So let's say I'm going to start with $380. That, you know, I made $380 on a trade that I want to now sort of just use it as play money. So I'm going to take that, and say I find a trade in ARG, I'm going to put the full 380 in there, right? Now, if I made, say, 11% on that trade, that's a $40 profit. I add that to the 380. Now I have 420. So now I take that full 420 and I try to find another trade to put it in. So I say I find BDX. Maybe I can't, you know, for a full lot spend the full 420, but I'll spend as close to it as possible. So I put 410 in there. It gives me a 66% return. That's a $270 profit. So now the 410, 270, you know, now I'm closer to 700. Now I take that and I put that into a full trade. Okay. Now, remember, if you're following your rules, okay, you're not risking the full amount. I mean, yes, you are in a way. If there's a big gap against you, you can get wiped out. But if you do, really what you're losing is 380 bucks, right? Your original. But what you'll notice around here is that, you know, if you have that, say, the 3-to-1 reward to risk ratio, is that when you're making money, you see a nice jump. And when you lose, you'll take a small step back, right? And go from there. And you don't have to carry this on forever. It might be a 5, 8, 10 step progression, whatever you decide. But it's a way where you can take a small amount of money, you know, maybe a previous profit or a portion of it, and, you know, pyramid it into something much bigger, right? By letting it ride, you know, the casino lingo, letting it ride. You take your profit, you add to it, and you let it ride, and you go from there. And you know, during a strong trending market, sometimes you can build it up fairly quickly. So I add that there just as a reminder, and sometimes when I do that, I can quickly just track it that way. Okay, so that's how I track it, and you know, you can do it on your own. Yeah. So someone said that worksheet only has the trade tracking tab. So all you have to do is right click down here to add another tab, and you know, you're going to get the recording. Go back and add these 3, and you can carry it on. I don't want to give you exactly my checklist and so on, because aside from being personal to me, it's not going to serve you well. Your job isn't to copy exactly what I do. You're a different person from me. You have to find out what works for you. So like Spiro, for example, he wouldn't care about everything else that I have here. He cares about, you know, are the Heikin-Ashi candles showing him what he wants to see? Is you know, the price above the guppy bands or below the guppy band? That's what you need on your checklist. You don't need my checklist. So this is just an idea of the way you can set up your spreadsheet. Okay, so I hope that helps. Any questions on that?
Robert says, Vince, for the checklist, what would you say are the minimums, the must-haves?
The must-haves are the hard and fast rules. So for example, for WMS, right? Are we going to trade long if the stock or the moving average are below the cloud or within the cloud? No, we're not. So that's a must-have, right? So that has to be one of the hard and fast rules. So, you know, the things that don't have to be on there are, for example, let's say all the criteria for the trade line up, but you know, for example, the US-China trade deal hasn't been resolved yet. Like, those aren't must-haves. Maybe the index chart isn't showing a strong trend on all 3 time frames. Yes, it would be nice, but that isn't a must-have. The must-haves are for that stock you're looking at, or for that ETF, or that Forex pair, you know, that what's on your trading plan for whatever strategy you're using, that those few things, those are the must-haves, absolute must-haves. So we're going to get into the basics of technical analysis now, and I'll share with you what I think the must-haves are there. But Robert, the things like trend and momentum, right? Those are must-haves. So how you read them on your chart based on the strategy you use is personal to you, but those are must-haves, right? So for me, the slope on the 20, a must-have, right? Higher highs, higher lows for a long trade, must-have, right? Those are what I consider the must.
David,
Yeah,
how do
sorry,
you
go ahead.
deal with multiple legs on the same trade on the spreadsheet?
So that's a great question. So what I do is that's where I use my notes field. So let's say that I had bought 100 shares of Yum Brands here first, and now it's pulling back, but I think it's just a minor retracement. I'm going to add another 100 shares. I'm going to go in and average these numbers. I'm going to update this same line. I'm not going to put in another line. You can treat it as a totally separate trade, but I don't. I would add the 100 here. So now I would say I have 200 shares, and I would average out the cost, etc. But in my notes field, I would say, added second 100 share lot on this date for this reason. Okay. Now let's say that throughout this, it gets to a point where I want to take some money off the table. So I'm going to sell 100, but I'm going to keep the original 100, right? I'm going to remove it from here. So in other words, this goes back to the original 100. I'm going to take out 100 shares. So the numbers will change here, and I'll make a note. But now I'm going to go and enter a closed trades of 100 shares. And I'm going to treat it like it was an individual trade. What my purchase was, what my sell price was, that was my profit. But in the notes, I'm going to make a note saying it was part of the Yum trade that was opened on this date. So when I go back to look at it at the end of the year, I can piece the two together and figure out what happened, right? That's how I treat it.
A couple of other questions. Ashwin saying, sorry if I missed it, do you update the trade tracking on a daily basis? And Robert was asking, is assuming that all three major time frames are in sync, is that a must-have as well?
So for the first question for Ashwin, yes, I update it on a daily basis because I mostly trade on the daily time frame. So at the end of the day, I will go in and update these fields, put the new close price for the stock, change the stop level if there's a reason to check the news, make any additional comments. That's basically it. If you're trading intraday, then you might want to wait till the end of the day when you're done all your trades and then fill it in, or you want to kind of update along the way. But this is more geared towards a daily time frame. For Robert's question, multiple time frames, yes, if that's important to you, like for me, for the longest time, that was absolutely a must-have for me, a must-have for me. I didn't allow myself to place a trade that wasn't aligned on all three time frames, and for the most part, I still have that as a must-have. So, are there times where I'm going to break that rule? Yeah, if I'm doing that progression thing, I'm not as strict. I'm playing with it a little differently, but for the most part, for my day-to-day trading, yes, absolutely.
All right, lots of thanks. And give a list of indicators that you have on TradingView.
Oh no, it wouldn't be fair for me to share with you all the indicators I have on here. First of all, many of them won't stay on here for long. They're for testing purposes. Some will pass the test, others won't. And like I said, for some of my private coaching clients, I will share this stuff, but I will tell you exactly what I'm doing and what the reasoning behind it is, so you'll know whether it remains or not. But TradingView has one of the most extensive lists of indicators available to you, both from a built-in, like your standard ones, to a public library where other members create indicators on there that are available to you. And you can see by the number of likes, you know, how good they are or whatever, and you can put them on and test them yourself. So there's literally thousands on there to choose from.
All right, let's get into our next session.
Okay, so the basics of technical analysis. So one of the basics obviously is price action, right? That is what's actually happening at that time. You know, are people buying? Are people selling? That's everything. The price action is the movement for that security, and it's telling you a lot. Okay, so yeah, it's random. It'll swing back and forth. Okay, but the price action is everything. It's like your, you know, your EKG for your heart, or your ECG, whatever it is, that will show your cardiologist exactly how healthy you are or unhealthy you are. It gives you all the clues without indicators, okay? So I'm going to briefly just go over the basics of a candlestick and how to read it bar by bar, because I think it's so important. Before we talked about, and I was asked about, what are the basics that you should focus on? These are the basics. So for some of you, it's going to be a lot of repetition. I'm going to try to go through it very quickly, but these are the basics. So price action, volume, right? Your actual candlesticks, whether you use candlesticks or open, high, low, close bars, Heikin Ashi, whatever you want to use, but those alone, without any indicators, are your true basics. Then there are a few other things that I want to cover, like support and resistance, for example, like drawing trend lines. Those are absolute musts, in my opinion. But let's look at this. So when you're looking at a bar, there's four parts to it. There's an open, there's a close, there's a high and a low. Okay, so whether you use candlesticks or open, high, low, close bars, or whatever you want to use, you're going to read it the exact same way. Okay, Heikin Ashi is a little differently. We won't get into that right now, but basically what matters is, where did it close today compared to yesterday, right? And what happened on this particular bar, whether it's a 5-minute, a daily, weekly, doesn't matter. What happened here? Each bar is a tug of war between buyers and sellers. That's basically what it comes down to. It's a battle between buyers and sellers. So if we look at these four items here, now on my slides, there's no color. The white represents a green bar, or a bar that closed higher. Black represents a red, or one that closed lower than where it opened, okay? So basically, the way you read it is, the opening price for a green or white bar here is at the bottom edge of the body, which is the square area that we look at. That's the body. The wicks here in the tails, the wicks is the upper line here, the tail is the bottom. These just tell you how far it moved around that day and where the absolute high was and where the absolute low was. The body is the difference between the open and the close for that period, okay? So if it closes green, it means it closed higher than where it opened. The opening price is at the bottom of the body and the close is at the price. Vice versa, if it closed lower than where it opened, the opening price is the top of the body and the close is the bottom, and it's colored in red or black. But the high and low tabs will always be the same, okay? So you're going to get different looking candles. You're going to get really little ones where there wasn't much of a tug of war, was there? That's what it means. How strong of a battle between buyers and sellers was there? Not much, right? There was hardly any movement, compared to a very long bar where there was quite a battle, right? Buyers pushed it all the way up here, sellers pushed it all the way down there, right? And then it closed at a certain level. So when you look at a bar and you look at the difference in size, number one, you want to determine, was it a big battle? Was there a lot going on? Or was it an uneventful day, a very small battle, right? Both have meaning. Now, the bigger the range from high to low, the bigger that candle, the more significance it carries, the more attention you should pay to those candles, okay? The smaller they are, the less significant they are. These are what we call indecision type candles, okay, where people aren't quite sure of which way to go with that particular stock or that particular market, right? So there wasn't much of a battle. When it's a wide range, there's a reason for it. But there's also candles that have a big body along with that range compared to a very small body with the same type size, okay? But when you look at something like this, you could say, boy, buyers dominated, right? We opened down here and it was a hell of a fight back and forth, but it ended up way up here, which means buyers dominated during that session, right? As where here we could say buyers won the war, right? It did close higher than where it opened, but it wasn't much of a war to begin with, so it doesn't really mean much to me, okay? And vice versa with the sellers. Now, the candles you should pay the most attention to are the ones with no wicks or tails at all, meaning they were the most dominant. And the wider they are, the bigger they are, the more important it is, because it means from the very open to the very close, buyers were in control, constantly pushing price higher. Even if it bounced back and forth throughout the session, what matters is where it opened and where it closed, okay? And vice versa. Here, it opened here, sellers pushed it all the way right into the close. They were pushing it lower. And so the wider that bar, the more important it is. But the fact that there's no wicks means you should pay very close attention to these bars. These are another example of those indecision type bars, where you get a big battle, but in the end, there's not much of a difference from open to close. So again, it's like a tie. Think of it as a tie between buyers and sellers that day. Nothing was resolved, okay? We can't say the buyers are winning. We can't say the sellers are winning. These are just a different version. A quieter day, not much of a range from high to low, but still we can't nominate a winner, can we? It was a virtual tie. So before we get to the lunch break, there are a few other things I want to cover, and I won't take too long, but let's go back to the charts here. So you want to be able to read the candles and say to yourself, ask yourself two questions always, right? One is who won the individual battle, day to day, or 5 minute to 5 minute period, whatever time frame chart you're on. The second question is who's in charge overall, right? So if we look at a stretch like this, right, and we see a red bar, right, we can say, well, sellers won that battle, right? But if we look back several bars, who's actually in control here, right? It's buyers, clearly, because we continue to make higher highs and higher lows, right? Pretty consistently, right? Because that's the other thing you want to look at when you're looking at individual bars, right? Are we seeing a higher high and a higher low from one bar to the other, or are we seeing lower highs and lower lows, right? That's what you want to gauge. When you put everything together, like for example, we're above the moving average here, and the moving average is sloping significantly higher. So that's telling us there's a strong momentum higher. But if we just look at these three candles, we can say, well, sellers won this battle, sellers won this battle, sellers won this battle, right? And we're seeing lower highs and lower lows, right? Pretty much. So is that something we should be concerned about, or is that actually something that's going to present an opportunity for us? So when you look at everything, all the indicators and everything put together, you'll be able to answer that question. But if you had no indicators and you were looking at this, what you need to be aware of is, again, you need to look at those candles and say, are they very wide in range? Like, are they much bigger than the other ones? Should I put more importance on these or not, right? And look at the volume and say, is there increasing volume during this time or not? Where's the next level of support and resistance? Those are the basics that you need. Price, volume, support and resistance, and your trend. Higher highs and higher lows, lower highs, lower lows. Those are your absolute basics. You should never trade without them, okay? So ask yourself that question. Who's winning the individual battles? Who's winning the overall battle, okay? And if you come to the conclusion that buyers are in charge here, then you should only be looking for a long trade, right? Whether you have other indicators on your chart or not. If you come to the conclusion that sellers are fully in control, then you should only be looking for short trades, okay? It really is that simple, okay? But what you'll notice is that near the top of a range, you're going to see some smaller candles. You're going to see those indecision type candles, because where, buyers are winning the battles, then suddenly there's a tie, right? It could tell you that the sellers are starting to gain some strength, right? For every buyer that comes in, there's a seller at the same level. It's an even match. So that gives you a hint that, hey, we're either just taking a pause before that next leg higher, or we could be in for a rollover. And that's the time where you start looking at, are we taking out lows? Are we putting in lower highs and lower lows or not? So if you just look at these few candles here, these four, let me zoom in, right? We were putting in higher highs and higher lows. Suddenly we put in a lower high, but we still have a higher low, right? Pure indecision, right? So we pause. Now we wait and we say, we have again a lower high, but we also have a lower low this time. Now that's a bit, it's not a very wide ranging bar, so not much to worry about, but it's another red flag. Now we get a bar that has a lower high, lower low, and is much bigger. We need to pay more attention, right? So we're right back at that 20, but as you can see, again, lower prices. Now it turned from there, but that's not the point. The point is what you're looking at to kind of gauge day to day or bar to bar, what's happening with your trade, and should I be concerned or should I not be concerned? Once you bring in support, resistance, trend lines, all those other things, it all comes together. But this right here is your absolute basic. Does anyone not understand what to look for when they're reading price action, when they're reading candles? Because, and Penn is saying, hard to know when it's a reverse or a fake out, right? A little later on, when we get to the advanced topics, I'll show you one way that you can tell for sure, okay? But generally, when you're not quite sure, ask yourself this: have we moved from higher highs and higher lows to lower highs and lower lows? That's what we need. That's what we need to ask ourselves. Because if you've made that shift, it's not a fake. It's real. Whether it lasts only a few days or not is a different question. But making that shift from higher highs and higher lows to lower highs and lower lows, that's what you need to look for. Any other questions? No? Okay.
All right, Tom says, good explanation. Tulio, nice to see you again. He says, Vince, for lower lows and higher highs, do you look at wicks and tails or closing price?
You look for closing price. Well, sorry. No, you do look at wicks and tails, but you reminded me of another thing. So thanks for the question. Let's go back to this area in here. Let me clear off these markings quickly. So you definitely look at the absolute highest point on the candle and the lowest point to determine the lower high and lower. So if you look at these two candles here, this green and this red, did we move to a lower high? Yes, we did. Did we move to a lower low? Yes, we did. you do take the wicks and tails into consideration. What matters most, though, is where did we close from the previous candle? So let's look at these two candles now, right? So this one you can look at and say, well, it's green, it hardly has any tails or wicks. The buyers won that tug of war clearly, right? You look at this one and you can say, well, we closed lower than where we opened, right? So the sellers won. But did they? No, they didn't. Because if you look at the close of this candle compared to the previous close, where did we close? We closed even higher, right? The buying was so strong, it caused a gap at the open, right? It gapped, it opened all the way up here. So then it pulled back a little from its high, but it still closed much higher than the day before, than the candle before. So this is still extremely bullish, okay? So not only does it matter what the close is compared to the open for that same candle, it matters what the close is from the previous close, okay? So again, yes, you take the wicks and tails into consideration for higher highs and higher lows, but you also have to pay attention what it means one close to another, okay? All right.
All right, do you see that one other question, Vince? Do you consider volume when evaluating the meaning of candlesticks? And Vince, how many real hours do you spend on trading, including research and follow-up? Do you have a life beyond master trading?
I do have a life beyond trading. I used to spend many more hours than I do now. Now with technology, we have scanners and all these great charting platforms with these watch lists, and it's much easier. But before, I used to actually spend many hours every night scrolling through over 3,000 charts a night, one by one, looking for setups. Now I don't have to do that. I can just run a scanner and have a quick list. But I still encourage all of you who are still learning, or are still new to this, I should say, because you'll never stop learning, to spend some time when you can flipping through charts one by one, because you need to train your eyes. Every time you look at a chart, you're going to see something differently, okay? You need to learn how to recognize those patterns that you're looking for, and repetition is everything. You need to train your eyes. So whether it's on a weekend or an evening or whenever it is, when you have some time, one chart at a time, even if you have a scanner at your disposal, put it aside, pick an index like the NASDAQ 100, scroll through all 100 charts one by one and looking for those setups, okay? It'll pay off in spades later on, trust me. Now, when it comes to volume, two things you need to know about volume, okay? And let me see if I can, I'm just going to try to cut and paste from something here. I want to put it on the chart, see if I can throw it on here. Let me take the text tool. Text tool. And put it on here. Let's see if how it looks. Okay. So can all of you read that? Forget the arrow and whatever. Low volume equals trend continuation. High volume equals trend deviation or reversal, okay? So if I were to throw volume on this chart, oops, that's not what I wanted. Let's go here and put volume. Okay, so I'm gonna put volume. Now, what you wanna look at when you look at volume is an average, right? So what stands out to you are the spikes, the much heavier days, but on average, what is the volume like, right? So you'll notice that here on the S&P, for the most part, the volume's, at that kind of range. And if you get average volume like that, it's like very kind of quiet volume like that, that's usually when you have a trend in place and it just slowly but surely grinds higher, okay? Now, that's different than lack of follow through. Don't confuse the two. But volume, when it's steady like that, just average, that's when you get those periods where you're clearly trending. It could be up or down, but clearly when you're just slowly but surely trending. When you get these periods where there's this higher volatility phase or consolidation phase, look what happens to the volume. It's all over the place, right? So higher volume equals trend deviation or reversal. There's something going on. So you really only need to focus on periods of high volume, right? Meaning you want to trade during the low volume steady trend period, but you want to pay attention to the chart when there's spikes, because there's a reason for it. It's either changing trend, right? Reversing, or something going on, or it's no longer trending, right? It's consolidating. So that's really all you need to know about volume is when it's slow and steady, consistent, that's when you're trending. As soon as you see spikes like that, it's a heads up. Is the trend ending? Are we going to go through a period of consolidation? What's happening? Something's changing. The volume will tell you that. Okay? Not one day, but a few days. Okay? All right. Now, support and resistance, there's a couple of different ways to identify it. And it's very simple, and it sort of goes hand in hand with trend lines. Trend lines is where you connect the dots, so to speak. So every stock has movement like this, for example. It'll move up, pull back, move up, pull back, right? These points, these highs and lows, are what we call pivot highs and lows. That's where the stock pivots, right? It was moving higher, pivots, starts going lower, pivots start going higher. So if you're drawing trend lines, you should only be connecting pivot highs together or pivot lows together, okay? So if I'm gonna connect this pivot high to this pivot high, great. There's no point in me connecting a pivot high with a pivot low. That makes no sense. But a pivot high to a pivot high, that's fine. And the more pivots, the more points I can put on one line, the stronger that level will act as support or resistance, okay? So when you look at drawing a trend line, you gotta ask yourself, am I doing it right or wrong? There is no right or wrong, there's just more right than wrong. Meaning, if I can only connect two dots, two peaks, that's not that significant. That's sort of iffy. If I can connect 3, it's better. 4, better. If I can connect 5 or 6, now we're really talking, right? So what this means is, see this level, we could have drawn this level way back here when we had 1, 2, 3, 4 points and just extended out. And we knew that whether it's 1 week later, a day later, 10 years later, when price approaches that level, it's going to run into resistance because that level is going to act as resistance. It pulls back. It bounced off it. Couldn't make it through. Tried again. Couldn't make it through. Now it's trying a third time. Will it go through or not? We don't know yet. We have to wait to find out. But let's say it breaks through. Now it's overcome resistance. And now that same level is going to act as support. And you can keep stretching it out. And the more points it touches, the better. Because now that it got hit another 2 or 3 times, it's even stronger. So now if the stock pulls back, you know you have support behind you. So now if you enter above here and it pulls back, you know it's likely going to bounce off that, okay? Because it's an even stronger level of support than it used to be as resistance, okay? So that's the key, is to line up lows to lows and highs to highs, but the more points you can put on a line, the better. So for example, if I want to connect this one to this one, I miss these 3, see? Right? So I can extend this out and this will act at some point as support when stock price pulls back. But it's not going to be as strong a support level as this line will, because I'm touching all 3. I'm even touching something here, even though it's not at the edges. But now when price pulls back, it'll most likely stall here before it ever gets to here. Okay? And it doesn't matter what time frame you're using. Obviously, the higher the time frames, the more significant it is. Okay? But that's really all you need to know, and that's what you need to do to find those areas of support and resistance. Okay? An easier way, if you have trouble identifying it or wondering, should I use the wick? Should I use the body? You know, all those questions. One of the most effective ways is to switch to a line chart. Okay? A line chart, the pivots are the closing prices, not the highs and lows. But remember, what matters most when it comes to price action? Closing prices. Closing prices are everything. Okay? And so now look for those areas where you can connect multiple closing prices, multiple highs and multiple lows. And then you can go back, put your candles on, and those are the trend lines you should pay attention to. And you can see what happened once it busted through resistance. It took off, right? So these are the things you need to practice with. These are the things you need to learn by actually doing rather than just listening. So take time, go through charts, and draw those. Now, you can pick any point and just draw a horizontal line, because at some point, right, from anyone, that's going to be a level that's going to be hit. Okay, so look at this one. Back here, back in May, we could have just extended out a horizontal line. And look what happened here. Price hit it and bounced off it. Then it broke through, came back to retest it, and bounced off. So first it acted as resistance, then it acted as support. Okay? But it wasn't that strong of a level. That's why it broke through, right? Now, with 2 touches, it became even stronger. With 3, it became even stronger. Then 4, then 5. So now, if price pulls back, this is going to be a strong level of support. Okay? So you don't need to keep these lines on all the time, but you need to be aware of where those levels are. I hope that helps. And before we break for lunch, here's the most important thing. Identifying trend and momentum is everything, should be everything to your trading. So a trend is higher highs and higher lows, or lower highs and lower lows. And the longer it goes on, the stronger that trend is. It's as basic as that. Momentum is the slope. So we use, or I like to use, the 20-period moving average, which is the blue line you see here. So I judge momentum, the amount of momentum, by the degree of slope. Okay, so you know, this would be very slight slope, right? This would be more. This would be much more dramatic slope, wouldn't it? So the stronger the trend, the stronger the slope, the better it is. The higher the probability your trade is going to work out for you. So focus on the ones that have, I'd say, at least a 45-degree angle on that slope. And for short trades, it's exactly the same thing, only in the opposite direction. Okay? So never trade without trend, never trade without momentum on your side. And here's the one thing that I'm changing in my trading now because of the current environment. And you all know how conservative I am. I'm taking a step to be even more conservative. Doesn't mean you all have to adopt this. You have to be comfortable with it. But as you all know, that, for example, let's say here's a setup on the S&P 500, right? It crossed back above the 50 line on the RSI. We have trend, we have slope. Let's say I'm going to get long here at the break of this high. Generally, I would say my stop is going to be just below the most recent pivot low, okay, which is here. And when I compare one trade to the other on a nightly basis, I take that into consideration. because how much risk am I taking from here to here, right? It could be several points, as where there might be another trade that is, you know, the pivot low is right over here, for example, and carries much smaller risk, but has the same trend, same type of momentum. I would opt for the one that has the least amount of risk, right? But the change I'm making in my trading now, because of the current environment, that I think would have saved myself some money along the way recently, is I'm putting my stop, my initial stop, just below the low of the bar that is just below the bar where I'm entering, okay? So to clear that up, let me zoom in. This isn't the bar I'm entering. This is my setup bar, let's say right now, right? This is the bar associated with that cross. So I'm looking for a break of the high here for an entry, but it means that Monday's candle is going to be here, right? This is Monday's candle. So this is actually my buy candle if I'm going to buy this on Monday, right? This will be my where I buy. So the candle immediately below the entry candle is this one, which means my stop is going right here. That's as tight as I'm having it. Okay. Now, yes, will I get stopped out a little more off? This is what you need to be comfortable with yourself. Okay. I don't want to lose any more than one bar away. Okay. That's, you know, that's how I want to do it right now in this environment. Yes, there's gonna be times where this during the day will come back and then turn around and stop me out. I don't care. I want to reduce the amount of my losses right now. As where normally I'd give it a bit more of a buffer. Okay, but right now I don't want to lose any more than a candle. So sometimes it's a bit of an odd thing where the candle, generally with the way we trade, where there's a pullback and then a move higher, it's always going to be the candle right before it. Okay. Sometimes, you know, if you want to get in, let's say there's a candle here, a candle here, and a candle here, right? And it turns, and you're getting in right away, but there were candles here, for example. This might be the candle that's below the candle where you're getting in, right? So your stop would go there. I don't have an example right here, but basically from the buy candle, which candle before that, you know, close below that candle, take the low, and that's where I'm marking it. So if this one was a very wide range candle, let's say it was a huge candle, big update, right? Oops, wrong drawing tool. Big update. Let's say it was this kind of candle. And now Monday's this candle, right? Am I going to be comfortable with putting my stop down here? Maybe not. So that might actually rule out that trade for me if I have another trade where my stop would just be this close by, right? I hope that's clear. So, and with that, let's answer whatever questions there are, break for lunch, and then we'll come back and get into the more advanced stuff.
Ray says, Vince, in an existing trend, when the candle bar ranges become wider and volatility increases, can that mean a potential trend change?
It can. You're talking more of a blow off top kind of scenario. And we can discuss that in the afternoon session where I show you how to look for a potential reversal, a high probability reversal. Generally, you see that with a high probability reversal. That's exactly the kind of scenario that you'll run into, and I'll explain that in the afternoon session.
Vince, when placing a stop loss, I'm sorry, I don't have the name here. When placing a stop loss, do you prefer using an actual number in brackets previous low or using a percentage in brackets 3% from the high. Do you have any thoughts on using either one?
I actually use a combination of the two normally. Let me explain. So I normally trade options. So for example, if this is the underlying stock, let's say, and I'm going to buy a call option on it, I would mark the level as a stop. So I would take the stock price level associated with that stop, and that would be a reason for me to get out. If the stock violated that price level, I'd be out. The other thing I do though with the call option is I never want to lose 50% of the value, more than 50% of the value of that call option. So if I bought that call option for $2 a contract, let's say, and before it gets to this stop level on the chart, it gets to that $1 mark on the option contract, I'll sell it. So whichever one comes first, 50% of the option or the actual price level for the underlying stock, whichever comes first, that's where I'll exit my position.
All right, no more questions other than what are you having for lunch?
I think there's a little pasta on the menu.
All right.
Get some energy.
I know you got a carb load, right, for the afternoon.
Yeah, absolutely.
All right, we will get to your questions that you had sent in the afternoon session. So right now I see 47 minutes, 48 minutes after the hour, Vince. Are we okay with restarting at 45 minutes after the next hour?
So 1:45, or you want to say
1:45 Eastern, yes.
Okay. We can even start at 1:30 if that's okay with everybody. If that's enough time, 40-minute lunch.
Robert says yes, he's spoken for the group.
Is that okay? Because there's still a lot of material I want to cover.
Okay, everyone says 1:30.
Okay, so let's come back at 1:30. Raul, did you want to show the offer now, or?
Oh yes, you wanted to show, Glenn in Arizona was asking, he had a question about veracity and saying that with the basic technical analysis knowledge that he has, can veracity be used, or does he need to have a little bit more advanced knowledge?
No, it can absolutely be used. Now, in the interest of time, I was going to show it here. So I don't want to take up your lunch hour, but so there's veracity that you can pick up on Metastock or on Tactical Trader, and I'll show you both in the afternoon session. But basically, each platform offers something a little differently, but the indicator is the same. It will do the work for you. It will identify those entries and exits for you. There is some work that you have to do in comparing one setup to another. But along with the indicator comes a training course where we explain exactly what you need to look for. So you don't have to be that advanced or have a lot of experience to use veracity. You can use it even if you're just starting out. You just need to pay attention to exactly the training program, and we'll give that to you. Okay. These platforms offer other things that you might want to look for as well. So, but what we've done is we've put together a package for you. So let me just briefly run through it before you go for lunch, because some of you have other things to do and won't be able to stick with us for the rest of the day. What we've done is put together two packages, and it's something we've never done before. Okay, this is a first for us, and because I think there really is a challenge ahead with these markets, that we want to give you as much ammunition as possible to tackle it with. So what we've done, and I credit Raul for all this, putting this all together. His idea, and I thought it was fantastic, to basically arm you with just about everything we have or close to it in the store. So with the package, the All Access Monthly Pass, you're not going to just get access to the veracity indicator, which you will get a copy of, but you'll have access to our Winning Momentum Strategy course, our favorite trade setup course, our timeless technicals, mastering debit spreads, college, everything that's listed here. So it's a variety of technical analysis, option strategies, our strategies, our equity strategies, everything we have here, along with our pro service, our membership, which includes the nightly videos that we send out, the live market chats that we have twice a week, every Monday evening and every Thursday morning, our private Facebook group, and our course of the month, etc. So you can get everything here for $297 a month, or the annual package, which includes everything that you see on the left here, along with a full year of access without any price increases, that sort of thing. You're grandfathered in. Any updates to courses along the year, and we're planning to do updates to many of these, and any updates to Veracity, which we may do as well. That's what the testing that I showed you earlier is all about, along with a one-on-one coaching session with myself, an hour-long coaching session with myself, and that's for $19.97 for the year. Okay, so 2 packages. I just wanted to highlight that before we break for lunch. We'll recap it again later on, and I'll tell you more about the one-on-one, the hour-long session with myself, what we'll do during that session. But that's something for you to consider as well. So
Sorry, Vince, I wanted to make one additional note. When we listed those courses on the left, Veracity, Winning Momentum Strategy, Our Favorite Trade Setup, I only had room for listing 3, 6, about 10 of them. But you get access to everything that we've done in the past. So the caller trades course, debit spreads course, these are ones I'm looking at because I'm looking at them because I'm mentioning them. Trading with volume, trading with the magic of price action. Every course that we've done, so any course that Vince has done in the last 5 years, you'll have access to it. And I want to thank John and Charlotte for sparking this idea. Vince, remember John was on holiday, and he was saying, "What is it that I can do to improve what I'm doing here?" So we wanted to create almost like a Netflix library for you.
Yeah, be honest. We wanted to say you should binge on Netflix, and then we thought, let's create our own Netflix.
So this includes every course that we've done, and with the annual, this includes every course that not only we've done, but every course that we will be doing for the next year. There's nothing else that you would need to buy. This was all included for you. Any course that you would want access to, including our previous market chats where we've done those little 10-minute segments, you'll have access to everything.
Including the veracity indicator. That's
including
right.
The veracity indicator, and of course you'll get training on that as well.
Yeah.
So like Vince said, we've never done it before. I'd love for you to take advantage of it. The yearly price, of course, is a lot better than the monthly, but if you want to just kick the tires and try it out and see if you like it, you can certainly do that. If some of you, and I know some of you are on the annual plan already, just let us know. What we'll do is we'll give you the credit for the prorated amount that you haven't used, and we can apply it towards either of these packages. All right, with that being said, we'll leave that up there for you to consider, and we will return in 35 minutes back for part 2 of the SuperConference 2019. Looking forward to it.
Thanks, everyone. See you in half an hour.
Welcome back. Nice to have you back. Hope you all had a wonderful lunch. Vince, are you back as well?
I am.
Okay, now I'm just trying to pull up my screen so that I can see myself. Can you see me?
I can see you. Can you see me?
I can see you too. Yes, we're back in our regular spot.
Excellent.
Somebody was saying that we had switched spots earlier. All right, Vince, I think we forgot to do something very important. We forgot to tell people how to get to that link. Some of you found it anyway.
That's a very good point.
So let me put that in the chat box.
Oh, that's funny.
To get the special offer today, use. All right, and we will give you an easier link to go by. We want to thank all of you. There's about 18 of you that have already taken advantage of it. We want to thank you all, and I think you really will enjoy. Somebody was asking, do we get access to the super conference from last year? Yes, I think the question, when you ask the question, do we get access to, I think the answer is pretty much yes across the board. The only thing you won't get access to is the personal consultations that Vince has had with some of the members for the personal coaching thing. But every other course that you can imagine, yes, you will get access to that. All right, Vince, we do have another giveaway. This one is for a cross pen, and there are some color options too. I've got blue, purple, black, silver, teal and aqua and red.
Sounds good.
The question is, how many times, let me just get it properly. Let me just get it proper so that I don't mess it up here. How many times does the phrase the United States of America appear on a new $100 bill? If you know this in the first shot, I'll be very impressed, because I know you only carry hundreds in your wallet. So if anyone would know it, you would. I've got 8, 5, 5. None of those are correct. 4, Michael in Los Angeles, also not correct. You got to go a little higher. Russell goes with a popular one twice. No, it actually appears quite a bit more in a circular format.
I'm going to use the excuse that I don't get to, try to win the prize, so I can't answer it.
All right, who said 12? I just see Trader in Los Angeles. Who said 12? That it better not be Ramesh again. We can't keep giving the same giving prizes to the same fellow. Who was that? Roger, nice to have you. You can put your email address and mailing address in the chat box. As I said, it is private, and we'll go ahead and send that out to you. I'll read this to you, Vince. Where is it here again? The answer is 12, 2 obvious appearances plus 10 times around the oval. Franklin's portrait is framed by an oval consisting of concentric rules, cross-hatching, and white space. Similarly, though different, ovals surround the portraits on all US bills. Using a magnifying glass, look at the outermost line of the oval. It turns out not to be a line at all, but the repeated words, the United States of America.
Wow.
All right, Roger, we'll get everything sent out to you. I do see your email address. If you want, you can put in your address as well, your home mailing address, and we'll get this out to you. All right, Vince, I don't have a lot of questions from the earlier session other than what you had for the offer. We'll mention it again towards the end of the show. Vince, why don't you get started with the next segment, and I'll queue up all of the questions, and the comments that were sent in by email.
Sounds good. Okay. So we are going to talk about advanced technical analysis techniques. Now, here, let me just, Ro, I'm going to take the camera off for myself. Yep. All right. When I say advanced, it's nothing overly technical, meaning hard to learn, but some of the techniques that are what I'd call them a little more consistent than others. So we'll start with moving averages, and the main ones that are used most often by retail traders as well as professionals. There's really 3. You all know I use the 20 religiously here. and that is a go-to for me. That may never change. But the other one that is used almost as much as the 50 period moving average, simple moving average that is not exponential. And the thought behind that is if price is above the 50, you can almost always call that a bull market. If it's below the 50, it's a bear market. That's the one that's used universally, I would say, for just to make a call on whether we should be looking for long trades or short trades. Something a little shorter like the 20 here narrows the scope and gives you that shorter term momentum aspect of it, as well as acting as support when price is trending strongly. So and there's nothing to say that you can't use both at the same time. If we throw on here a 50, get to, here it is. Let me throw two more on here. I'm going to throw on the 50. And let's give this one a color. I don't know, let's do purple. And the next one would be the 200 period moving average, which, is used by a number of people, but isn't always on everyone's chart. We look at it more when an index is about to breach that level, but not so much during day-to-day trading. But again, having a few moving averages when they're on your chart, when they're stacked appropriately, right? 20 over 50, 50 over 200, you can see that generally price moves higher. Of course, there's going to be fluctuations back and forth, and you can use those for entries and exits, but more than not, when price is above the purple line, right? That's the 50. You can pretty much count on it going higher. When it's below, that's your downtrend, okay? And then you can tighten it up with a 20. You can add a 10 period, you can add an 8 period, whatever you like. Couple of minor things to remember, whether you're using just one moving average or you're using multiples, because a number of people like to use the moving average cross system, okay? So if we were to use just the 50 line, which is this purple line here, actually, let me get rid of the cloud here. That way, it's not in our way. There we go. So what I'm looking at is this area in here. Okay. So the purple line is the 50. So if we're just looking for an area where we cross from below to above, right? That's really when the trend changed, right? Now, we can say, hey, before that, we actually put in a higher low, right? Which was here. This low is higher than this one, right? And a higher high from this high to this high. So the trend actually had shifted, right? From lower lows and lower highs to higher lows and higher highs, okay? Cross of the 50, makes it even that much more significant. But, or we could put on a shorter term moving average and say, wait for the 20 to cross the 50 and have a slope in place. That's even better, right? It may happen a little later, it may happen a little earlier. It all depends. But one of the main things that you should look for is a break of a previous high after the event has taken place, okay? So just like down in here, when we switch from lower highs to, lower lows and lower highs to higher lows and higher highs, right? A break of this high here, a break of then the higher high later, which happened on this bar, which happens to be the same bar where we closed above the 50. that really was the turning point there. That was confirmation that everything is in place and we have a new trend going, okay? But after the event, if you want to be even more certain, you wait for a break of that next high, okay? That way you avoid any sort of head fake, for lack of a better phrase, right? If it crossed the 50 and then failed immediately, whether it was a 1 candle cross or 2 candle, it doesn't really matter. One way to avoid that fake out is to wait for a break, okay? So for example, look at this section in here, okay? Back in here, right? We dipped below that 20. Right? Actually, we dipped below here. We came back, we crossed, and we didn't go anywhere. We pulled right back, right? We crossed again, didn't go anywhere, pulled right back. It's when we take out a high that now we start to move. Okay? We break out, come back, don't even breach that high, and just continue going. So every stock, like I said, moves in, you know, different ways, but there are periods where it moves forward, periods where it retraces, and so on. And those pivots really matter. And the break of the pivots are usually when you get an acceleration of that price. More importantly, when one of those pivots is an all-time high. So Apple up until this point, let's say there were, you know, it was, I don't think it was, there was some history back here. But if this was the all-time high at that point, okay, and we retrace, now when it takes out that high, which happens to be that same level, okay, that's when that acceleration happens. Now, even here, there was a head fake, you see? You came in and you immediately reverse course, okay? And I said I was going to talk about this more, and I will a little later on. This is very important. How do you know whether it's going to be a fake out or not? You really don't know when you first cross. You've got to wait to see if there's any follow through or not. But more importantly, what do the candles right after that cross look like? Remember, going back to the exercise this morning where we were trying to read one candle at a time, right? What is that candle telling you? I mean, if we zoom into this area and we just look at this candle here, from a tug of war perspective, right? What kind of war was this compared to these previous wars that it was fighting? Oops, I didn't mean to do that. Let me try this again. There it is, right? If you look at the size of the candles before that, right, weren't many that were that size, first of all. So a much more significant bar. Secondly, who won that battle, buyers or sellers? Well, sellers certainly did, right? And where's the close today compared to the close from the previous candle? Much, much different, right? So actually, that's not even the one we were looking at. Let me go back. I apologize. Where was it? Yeah, it was this one in here that we were looking at here. So again, look at the size of these candles. Not very significant. Suddenly, there is one that gets your attention, even though the close was still higher than before, right? But after pushing it past that previous high, sellers came in and drove it lower, and it actually closed here. And then the next day, boom, gets knocked down again. So that's not a sign that we're going to clear that high anytime soon, right? That's a very bearish sign. That's a clear sign that we have run into overhead resistance and we're failing. So what happens after that? We pull back some more. Then later on, we go through and we break back above. But again, it came back up here because it was rejected immediately again, a second time, right? And then it took many, many more days before it finally crossed. Look at this time when it crossed, right? So let's just compare these, right? You get this candle is when it crossed the first time. Didn't close there, but it crossed there, right? What happened next? boom, immediate rollover, right? We move over a little. This one, we couldn't even get above it, so it's totally insignificant, right? Indecision candles followed by reversal. This one, this candle here popped above, but doesn't close there. So we continue to watch. What does this candle tell us? That's pretty positive, right? And we actually closed there, right? And then clear follow through. So now we've seen what we want to see. We can confirm that we have cleared that level and we're on our way. And in fact, the market just goes higher from there, right? So when you're looking at a possible head fake or not, there's a couple things that you want to look for. Not only do you just draw that level and wait to see if it closes above there rather than just breaching it intraday and pulling back by the close. Okay, so the fact that this candle was above there during the session but actually closed below it, that's not a very positive sign, is it? Right? But then the next candle really said it all. And same thing over here, and then that was the difference here. We got a bust through it here with authority, right? Nice strong candle. So generally when you're breaching a level of significant overhead resistance or to the downside where you're breaching support, you want to see clear follow through, and it's okay to give up a little bit of profit there to wait and confirm that so you don't get caught up in this sort of thing, especially when it's breaking out to a new all-time high, because then there's no resistance overhead and there's no telling how far that can move, right? So there's plenty of room for profit is what I'm getting at, where you don't have to time it. I mean, I've known traders who, to the penny, wait for a cross, the first cent above that previous high. They'll jump in. They're waiting to pull the trigger on it, but more often than not get caught in that head fake. Okay, so you want to avoid that. You definitely want to avoid that. Now, there's also chart patterns that you look for at that same time, okay? So always look for multiple reasons for one thing or another to build a case on a trade or not. So for example, let's say that we had a shoulder here, a lower pivot, then an even lower one, and then a higher one. So we had a reverse head and shoulders pattern, but we were approaching that level. So now, it would give us more reason to believe we're going to bust through, right? Because we have that kind of pattern in place. You could have a double bottom. What if price came right back here and then moved higher? Well, if you have one bottom here and one bottom here, right? And the midpoint high between those two low points is here, let's say at the time, the double bottom is confirmed as soon as it breaks this level. And you're just a stone's throw away from this high. Well, what's likely to happen? You're most likely to break through, right? So when you're looking for, or you're looking to confirm something like a breakout, you're not just looking for price to cross. You're trying to piece everything together and build a case for why it should or shouldn't get rejected there, right? And that's why, again, you go and look at multiple time frames, because over here we have limited data. We may not see what's to the left here, but if we switch to the weekly chart, we may look back and say, oh, there's, more times when this level was tested, maybe all the way back in here, maybe it was tested numerous times and failed, right? Who knows what we're going to find when we look at the longer time frame. So then we go to the monthly and we say, is there anything there? Now there doesn't appear to be anything there on this one, but in previous, on different charts, you can definitely find that. okay? So you want to look for those things to come together, but always wait for confirmation. So at the end of the day, if you have a pattern of higher highs and higher lows, for example, and you have a moving average that is sloping significantly in that direction, you know you have a strong trend. So the odds of that continuing are very high. They're not perfect. They never will be perfect because the market can be affected by many different things, right? So Apple, it may look like a great trending chart here, and then we get a headline to say that talks broke down between the US and China. China walked away from the table and said, forget it, we're not making any deal with you, and the whole market rolls over. What do you think is going to happen to Apple? Regardless of the strong trend, same thing is going to happen, right? So nothing's ever perfect, but the odds, barring some outside event like that, the odds are this should continue to just slowly but surely trend higher. And one of the easiest ways, or I should say the earliest ways to catch it, is across of a major moving average like the 50, right? So if we remove the other moving averages from here, the 20 and the 200, and we only leave the 50, right? Back in here, we were trending lower, right? Now, did we make a switch here from lower highs and lower lows to higher highs and higher lows? We did. And actually, those carried through for a while, right? So if we compare this low to this low, right? That was a higher low, then another higher low, right? And another higher low, and another higher low, etc., right? All the way through. Same with the higher highs. Okay? So when we crossed and we put in that low that was higher than this one, we already knew good, strong chance we're going to follow through. Then we take out the high, and now we have another higher high. Obviously, this is going to go up. We have slope on that 50-period moving average. Things look fantastic, right? Then, as soon as we breach a low, there's a red flag, right? Now, even without the moving average, you pull back here, and you make a lower low, okay? So you didn't know where the pivot was going to end, but you knew as soon as it broke this one that you had a lower low in place. Well, it happened to create a pivot below the 50, okay? But even if we didn't have that 50, once it pulled back like this, we knew we had a lower pivot. So that was a red flag. Once this pivot was created, and we knew we had a lower high, wouldn't that be a great spot to get out of your trade, right? I mean, you probably would have been out here, especially if you were trailing your stop. But who knows how big of a pullback this can end up being, right? We don't know at that point. So clearly, this had told us to shift gears. And if we had shifted from long to short here, okay, yes, it didn't really go anywhere. It turned around pretty quickly. But once it breaks that high after, right, and puts in a higher high, now you know this isn't working out. You switch gears again, higher high, higher low, and off you go. So just to go back to the basics, that's really all you need. You can read the market just based on the price action like that. The moving averages, RSI, all these other oscillators and indicators, they help visually give you a heads up to what's happening, right? And they're much easier to use and have faith in and so on than your ability to read price. But if you can gain some confidence in reading price, that's really all you need, okay? But remember, when it crosses, right, remind yourself, what are the two things that you're always looking for before you trade? Trend and momentum. So what was momentum like here? moving average tells you? Not much, right? Totally flat. So yes, we moved higher. We crossed that. Momentum was totally flat, right? So where are your high probability entries? Your high probability entries are on those areas where you pull back and you set up again and you break another high, right? But you do so with momentum. Okay? So now, if you use something like a winning momentum strategy or veracity, it may tell you down in here to get in, okay? We try to find an earlier entry. But really, if you just hit those highs, break out to new all-time highs, no resistance ahead, you have momentum, you may have a charting pattern here that supports it, you may have a candlestick pattern that supports it. That's really all you need. Then it's a matter of setting up your trade in a way where you don't get hurt, meaning by the appropriate number of shares for your account size, right? 1 to 5% max of your balance, the lower the better, right? You set your stop nearby, okay? And you follow it religiously. All those things that you set up your account in a way where even if news came out to say, Tim Cook falsified the books on Apple. Apple's not worth 254 bucks. Apple's worth more like, I don't know, 130, right? And so it gaps and it opens down here the next day, right? If you only put 1% of your account in that trade, that's all you can lose, right? So you can have that same bad experience, bad trade experience without the financial loss that you did the last time, right? That's what protecting your account is all about, okay? So while you can keep it simple, it doesn't mean it isn't advanced. It doesn't mean you're not putting the odds in your favor. You really are if you're paying attention to the right things. Now, we can throw all sorts of indicators on here. Like I can tell you the RSI, right? Whenever it moves above the 50 line, a real strong chance price moves higher, right? Moves above the 50 line, price moves higher. Moves across the 50 line, price moves higher. We've seen it over and over and over. This is one of those things where you can go back and history will tell you the majority of the time it will do exactly what you thought it was going to do, okay? So you can support your analysis with these other indicators and so on. Give yourself additional confidence, but it's how you're looking at the market, how you're looking at price, what those candlesticks are telling you, etc. Support, resistance, trends, those lower lows and lower highs and higher lows, etc. What are they telling you? That's really what you need to do, okay? That's what you need to focus on. Now, when it comes to identifying those big reversals, okay? Let's see here. Let me see if I can show you examples on the index charts. Okay. Now, let's go back in time. Okay. Let's take it one at a time. Here. So the .com collapse, right? Were there any signals in the .com collapse that could have given us a heads up that this move was over, right? Same with the 2008 crash, same with everything. You know, an individual stock that runs up and then suddenly collapses. Is there any way to identify it? It comes back to reading price, okay? So look at this strong move, 96, 97, 98, 99 especially. What a year that was, Okay, if any of you traded then, boy oh boy, I can tell you that was a ride. But most people that turn a few $100 into millions here gave it all back right here the very next year. Gave it all back. And if they were on margin, gave even more than that back, right? All because they didn't read price action. Whenever you look at breaking out to a new high, okay? So you're moving higher, you pull back. This is the high over here, right? Breakout, what happens? It goes higher, right? Pull back. Now which side? This is the high now, right? Well, look what happened here. If you just look at this one green candle here, it looks a lot like this breakout candle, doesn't it? Identical. Remember what I said earlier? Is there follow through? What happened on the next candle? What does the next candle look like? This one looks pretty much the same as this one. Tells you we're going for it, and off it goes. This one, what happened to the next one? Was a complete rejection, a complete reversal, right? Now, this market was so strong here, so strong. In fact, look how far away it is from that 50-period moving average compared to before, okay? Because that's a clue as well. But this market was so strong that even though we had that quick rejection there, most people just ignored it completely, okay? And actually, it came in and it tried it again. Now, what's the high here? This is the high, right? Look at that green, big green candle, breakout, heads up, we're going long, people buy in, pile up, right? Well, was there follow through? We couldn't even take out the high of that candle. Complete rejection once again, right? And in fact, this market was so strong that it attempted it a third time, only this time it couldn't even break the high once, and it was a complete rejection. And from there on, it was over. But people were in denial here, thinking, no, it's just a retracement back here. Look, then it gave a bullish engulfing pattern here, right? We thought, okay, now that's a much better place to buy. We can go, right? Yeah, would have got you in that trade, would have tripped the high. Well, what happened immediately? Rejection, right? So if you try to enter something like this, and you put your stop here and you get stopped out, yeah, okay, you'll lose some money. But if you want to know whether it is going to follow through or not, or whether it's a head fake or not, just look at the next candle. And it pretty much tells you everything. Could it have gone here, hit the 50 and bounced again and came up? Sure, it could have. If it did, who cares? Think of it this way. If I got in here, okay, at the break of this high, and I noticed this head fake went against me. So I thought, well, I'm not going to wait for this to collapse. I'm going to get the heck out of there. And then it prints another candle and comes this way, right? I can always jump back in. If the slope is there, I'm taking out another high. If it's a confirmed breakout, again, beautiful, I'm in. So what I gave up a little here, I'm in for the rest of the ride. But by me ignoring the rejection, I'm in for this kind of beating, just like we were up here, okay? So there's two ways that you can look at it. You can get a huge move higher, get one candle, a huge move. So if all these candles along this line were small, they all look like this, all very close, all very similar in size, very small, but moving sharply higher. Then we get a huge bullish bar. And let me change the color on here if I can. Okay, we get a huge bullish bar, but that's followed by a huge bearish bar, especially if it's on high volume, that's your blow off top. And then from there, it's this. Okay? The sharper that rise, the quicker, the faster it happened, and the higher it went, the stronger the pullback's going to be. A more obvious way to recognize it is when you're taking out a previous high. So if the market had gone up here and pulled back, right, and then consolidated kind of thing here, and then we had this bar that breached this high, right? So it looked like a breakout, but you get an immediate rejection. See you later. That's an easier way to spot it when you're looking for a breakout to new highs. But when a stock has just been climbing higher and is already at highs and just keeps pushing up like that, but you get a major rejection, right? Okay. Sometimes it doesn't go all the way. Maybe it just kicks off a period of retracement. But when you're in this trade, you want to be out on that rejection. Okay. That way you save yourself the agony if it does turn into something much bigger. See this red bar here? You were going strong red bar, but it didn't even breach the low of that bar. So was it a down day? Yes, it was. It wasn't a complete rejection because you didn't take out the low of that bar. It didn't completely reverse it and then some. And sometimes it'll be a little indecision bar followed by a big red bar that takes out the low of that green bar, right? It's not always as clean as just two candles like it was over here. But you got to read the candles to tell you what it, the candles are telling you everything, right? So don't look at all these other indicators and everything and think this trading stuff is so complicated, right? I'm never going to be able to learn all this stuff. All you really need is price. The indicators, the oscillators kind of do part of that work for you. So, you don't have to read every single candle to judge the momentum behind that move. You can just look at the slope of the moving average, etc. Right? And look at some of the more common, more reliable charting patterns. So what are those? Head and shoulders pattern, right? Where you have a pivot, you have a slightly higher pivot, and then you have another slightly lower pivot here, okay? Now, so you have shoulder pivot, head pivot, shoulder pivot. When is this confirmed? When the lowest point between the two shoulders, which would be right here, when that gets taken out. That's your confirmation. So not here, because this now can turn and just go back up this way, right? It's when it takes out the lowest point between the two shoulders. As soon as that happens, it's over. Big time reversal, and it should be coming back. So a lot of the times that's what you see here at the same time. You can say shoulder, head, right? Shoulder. What's the lowest point between those two shoulders? Here, right? What happened after that? See you later, right? You can look at a double top situation. Okay? Now, a double top, double bottom, I would pay very close attention to volume at the same time. Okay, let's throw volume on here and see if we had anything here. It's there. Okay, so here we didn't really see it, but what you want to see is, and especially for a double bottom, like here, we did see the double bottom right here. So we got a nice strong push lower. This was one bottom here, and you had a big spike in volume. It tried to rally, but failed, came back not quite as low as this, but close, and had another spike in volume. And then the highest point between those two lows, which is right here, that gets taken out, and that's when we start moving higher. Okay, so you're going to see head and shoulders patterns, whether it's up here or inverse head and shoulders, like I showed you earlier, or double tops, double bottoms, okay? Or the island reversals. Those I would pay a lot of attention to. And by island reversals, we're not going to see them here. What chart has an island reversal on? Can anyone help me out here with an island reversal? Let me try to go by memory. That's not it. DIA, let's see. I guess recently you're talking about here, Robert? The island reversal? Or UNH? Let's see. I'm just looking for a really clear one. So we need a gap down and then a gap up, or vice versa. So there was kind of one here where there's a bit of a gap here and a bit of a gap here, leaves these candles on an island of their own, and it completely reverses course, right? Yeah, even the Dow recently in here, so you had a gap down and a gap up, right? So it's rare that you see it with one candle, but it's the same sort of thing. Gap lower, gap up. This candle is on an island of its own, right? So when that happens, on that next gap up bar, if the high gets taken out, that's a very strong reversal sign, okay? And it can happen in the opposite direction as well. So the head and shoulders, double tops, double bottoms, island reversals are some of your strongest price action reversal formations, okay? Pay attention to those all the time, okay? Any questions on this? While I look through my notes, I want to make sure I'm not missing anything here.
Jose in Kings Park says, Vince, won't it be better using a 10-day moving average on the monthly for a quicker heads up on the break, specifically on the monthly?
Oh, I was getting to that. That's in the strategy session after our break. Absolutely. That's one of my favorites.
Okay,
You're
Jose,
absolutely right.
Jose obviously got a hold of the notes. Jose, you and I have to talk after the session how you do that. I could have used that back in my university days. There was a question. I'm going to read the question from Elroy that was sent in by email. He says, Vince, I've learned much from your expertise and want to learn more going forward. And of course, relearn some things. I'm mainly a swing trader with stocks and options, and my trades vary anywhere from a few days to a few years. I'm not interested in day trading. A question I have is, what are the best strategies for different economic and perhaps political environments considering technical analysis only? I've been mainly in cash for the past quite a few months and have done okay with minimal gains, but I feel I should have done better. I feel that the market is news driven and that the news are very politically driven. Some experts say, it's going to go down shortly because of what's happening politically. I would like to think one could use price action along with trend momentum, moving averages, etc., of the 4 major indices, along with perhaps the 10 or so sectors as an indicator for stocks. I have dabbled a little with calendar spreads, dividend stocks, having good option chains, etc., and have mixed feelings about doing that, but would like your thoughts. Again, thank you much for helping me with my trading. Would like you to expand on the above.
So Elroy, one of the reasons why I just went through everything was for you, exactly because of your email. I had read it earlier. So thank you for that. That's exactly right. Everything we've just talked about will allow you to block out the news. I mean, it's always a good idea to listen to the news, to kind of anticipate whether there's more coming with that story or not, etc. But price is what's happening now. What you see on the chart are real trades. People are actually exchanging shares, exchanging money. It's not what people are thinking. It's what people are doing at that time. Okay. It's actually human behavior reflected on a chart. That's why when people scoff at technical analysis, you know, I laugh back because it's reality. That's what is actually happening in the markets right now. So whether a company has what one might consider a low PE or a high PE, what does that have to do with what's happening right now on the chart? If the chart right now is telling you that this thing is putting in lower highs and lower lows, okay, and sellers are clearly winning every battle out there, does it matter that on paper that stock is supposed to be undervalued, right? Why would you want to buy in if sellers are clearly in control here, right? Or like there was back here on the Dow. For whatever reason, people are selling. So what I always say is, don't ask why something is happening. Never ask why something is happening when you're trading. If you ask why, you're bound to lose money. You got to ask what is happening. And if you can answer that question, you should be able to make money in the market, any market. So yes, the Dow was dropping here. Do we really need to know why? No, we don't. All we need to know is what's happening. Well, people are selling, obviously, right? So do we want to walk in front of this train? No, we don't. We may want to jump on board and ride it down until we see there's that big reversal, right? Huge reversal with follow through, followed by a higher low, right? And then eventually a higher high. And then we're on the train going north again. But price tells you everything that's happening now. So what you were saying, Elroy, by just a few of the sector charts, right? Like we review every Sunday in our videos, the energy, the financials, techs, etc. That'll give you an idea of what's happening in all the different sectors around the market. And if they're all pretty much aligned together, or 8 out of the 10 are showing that sellers are in control, what makes sense? What could possibly happen next? Most likely is it'll continue to sell off, right? So that's a great way to gauge what's happening in the market overall, but you need to read price. That's the main thing. And hopefully the way I've explained it today has made sense. But you have to understand what each candle is telling you, and then take a bit of a step back and look for those charting formations and say, well, is there anything bigger happening here? And look at the basics: higher lows, higher highs, trend lines, slope in the moving average, break of a previous high. That's really all you need to know. A bit later on, I'll go through the pencil and ruler method quickly. Many of you have seen it in the past. It's a method, a strategy we used to use, almost 30 years ago, when we didn't have all these fancy charting tools, and we actually had to create our own charts with a pencil and a ruler. That's why I gave it that name. Works just as effectively today as it ever did. And so you really don't need all the fancy indicators. The veracities of the world make life easy for us, right? Rather than us sitting down and taking hours trying to go candle by candle and compare this chart to that chart and figure out which sector is better, whatever, we can just run a scan and say all the criteria is met because it's already programmed in. So if it's giving you a setup, chances are, most of the work is already done for you. Then you just compare one to the other. You make your selection, place your trade, and off you go. So it's making life easier for us. But really, the work that went in behind it in creating that strategy, that all came from the basics that I've just taught you here. And so now with the markets the way it is now, right? Because another question, I don't know, Raul, if you want to read that question up, but it had to do with how do we avoid getting hurt by a black swan event now? Like, for example, markets are trending higher here. What if suddenly things just turn around like they did back in you know, the year 2000, 1999, 2000, the dot-com, and then just completely collapsed, right? Because if you look at this right now, the Dow, this is a perfect example, right? What just happened in the Dow? Wasn't this a previous high? Right. Okay. Did we break through? Yeah, we did. Not with any sort of conviction. If you read that candle, that's an indecisive candle, right? But we did close above there. We did technically follow through, right? Again, what have I been saying in the videos and our market chats? The lack of follow through that concerns me, right? What just happened here? Massive reversal, right? Now, we get jobs number, whatever else, some other reason here. There was some rumor on the China trade deal potential, something like that. And we're right back up there, right? We haven't taken out this high yet. And we do have a lower low. So we could just see one massive reversal bar here again, and then that kicks off something much, much bigger. So how do we avoid getting hurt there? Well, number one, we continue to read the candles one by one so we can identify that. And I mean, if this is going to be an epic collapse, right, where it comes all the way, you know, and loses 50% of its value, which I think is conservative, it could lose more, we'd be out somewhere up here if we're reading it correctly, right? Maybe worst case, if we miss part of it, we're out here. But we're not going to come all the way back here before we realize it, if we're reading this correctly, right? So what else can we do? How can we hedge ourselves and so on? Now, the obvious are buy some puts on the SPYs, buy gold, buy silver, right? Buy a few call options on the VIX. We can all do that. A few other ideas. One is, tighten up your money management plan, right? If you're used to putting, say, 5% in every trade, tighten it up a little. Maybe go to 4, maybe go to 3, 2.5. Ease up a little. Secondly is, change your focus and put in more on dividend-paying stocks, right? Why? Not that they're not going to get hurt when things roll over, because they are, but they just won't get as hurt as others because they pay a dividend, and as the stock price moves down, the yield on that dividend moves up. And so you're going to get to a point where once they're paying 6, 7, 8%, 10% in some cases, institutional money will come pouring in because people are looking for yield. Bond markets are horrific for yield. Everyone's looking for yield. So those will feel less pain than non-dividend paying stocks. You want to diversify a little, and it could be in areas outside here. I'm not just talking about, buy an energy stock, a gold stock, a technology stock. I'm not talking about just that kind of diversification. You can look at buying different asset classes, right? Moving into some commodities, some currencies, some REITs, right? Real estate investment trusts, going outside, going international, and picking up some international funds, some, emerging market funds, that sort of thing. Something a little different, something with a little less exposure to the market we have here, right? You can also look at picking up the ultra short ETFs, right? So, for example, ETF for the NASDAQ is QQQ, right? Same chart as the NASDAQ chart, follows the same thing, it's just the ETF. But if you look at QID, for example, right, it trades in the opposite direction. It's ultra short. So when NASDAQ goes up, this moves lower. So if the NASDAQ is going to collapse, this should make a move higher, okay? And you can look at the same signs here price-wise as you do there. But because the market's gone up so dramatically for so long, that a lot of these ultra short ETFs are very, very inexpensive. So you're picking them up at very inexpensive prices. And if we get the kind of collapse that we're all expecting in the year to come, the move to the upside here can be dramatic, to say the least, right? So there's QID for the Qs, there's DXD for the Dow, right? There's several of these. I'm just giving you some of the more popular. The DOG for the Dow. There is for the Russell, TWM. That's one, and RWM, I believe. Yeah, that's another one. And the SPYs, you have SH and you have SDS. It's another one to look at. Okay. Most of these have options. Most of them very liquid. Again, very inexpensive. So can be used as a hedge, can be used speculation, whatever you want. But of course, you know, we haven't seen a confirmation yet that the turn has started. We've seen hints, but no confirmation. Okay. And then there is, let's see, international ETFs. EFC, I think, is one. Yeah. Again, this is an ultra short. So number of options there. Others are putting in examples here. So Robert is saying SPXS for the S&P. Yeah, you can just look them up. There are many. Just look up ETFs or ultra short ETFs for the index and the indexes. And that's right. And Robert says like that's a 3 times short. So the way they're structured is they're leveraged. So there are 2 times leverage and 3 times leverage ETFs, meaning that if the SPYs make a bigger move, a bigger drop, right? The 3-time ETF should have a bigger move than the 2-time or just a regular ETF, right? Because it's a lot more leverage. So when it's this inexpensive, and you can spend even less money by picking up an option contract, right? I mean, what are you really spending? A couple bucks, right? For the chance at a lottery ticket if we do get that drop, right? So again, an inexpensive hedge, or you know, a well-calculated move once the rollover is confirmed. Okay, so again, if there's any questions, we do have a question from Penn. How far out on expiration on these hedges? A yearly leap? Penn, yes, that would be great as long as you're not spending too much, right? So the balance with the expiration date on an option, and our next topic is options, so I'll get into it a bit more, is the balance between, you know, the cost and the time that it's affording you, right? So yeah, it'd be great to cover the whole year. So if I thought at some point in 2020, I'm not sure which month, but at some point the crash is going to begin, I want to cover my whole year off, right? So great. So, you know, if we go to Jan 2021, I'm covered. So let's see how much more expensive it is. If we look at the $15 strike, okay, it's about $3 a contract. If I go say out to June, midway through the year, 15 is about $1.95. So, you know, I've got to add another third of the expense on there. So am I willing to spend $3 compared to, you know, $1.95 for those extra 6 months? Yeah, I probably would, right? But it depends when you're looking at these. Sometimes they're much more expensive the more time you buy. Sometimes they're not much different. So I'd buy as much time as I could, as long as it was still reasonable. The cost was still reasonable. Okay, so always compare that. Sometimes you can buy even more time. So like if we go Jan 2021, that's a little over a year out. But what if we go to Jan 2022? We buy ourselves 2 years, right? Now we look at this and say, well, that's going to be, you know, about $6, twice the cost. No, that's too much. But what if it was $4.50, right? Would you say, well, hey, because if the downturn starts next October and then lasts into the following year, then I'm covered too, you can say, right? But, you know, I wouldn't try to go out that far, especially not with a hedge. A hedge is usually to cover over the next month or two, right? If you're using that as a hedge. If you just want to get out in front of that coming collapse, then I would stick with the Jan 2021s. Any other question?
Tom says, sounds like you're looking at buying insurance. And Bob says, say this past Friday, market's up a lot. However, fear that a Trump tweet on trade might tank the markets this coming week. How would you hedge in the near term?
Well, exactly that. So you just buy shorter term expirations. So, for example, if we buy this January, right, 41 days out, right? See, it's going to cost us a lot less. That same $15 contract costs us 50 to 60 cents, right? So, you know, what you want to do is take your portfolio as a whole. Let's say your portfolio is worth $10,000. That's what you have exposed, right? That's the amount of risk you have out there over multiple positions. It's 10,000, let's say. And then you want to say, well, what's the percentage chance that this thing turns around? If it's like hardly any, like 10% chance this thing is going to turn over, or if it does, it's just going to be, you know, like a 5% retracement, not a big deal, not a collapse. If that's the case, you're not going to go out there and buy $5,000 worth of ultra short options to hedge yourself, right? You're not going to hedge at 50%. You're going to go in and buy 10% of what you hold, buy $1,000 worth or buy $500 worth. But if you've already seen the signals that this thing is turning and it's more insurance than hedge, to me, there's a bit of a difference with those two. The hedge to me is, you know, the off chance that something unexpected happens, which drives my positions against me, compared to, I'm pretty sure this is going to go sideways at some point. I'm just not quite sure when. So I'll buy some insurance because I know I'm going to need it at some point. That's how I look at that. Then I may be willing to put a bit more into this, but you know, I would maybe buy more time, right? But for a Trump tweet or so on, you're going much shorter term. There's no point in going out and buying leaps and spending a lot of money. You can protect yourself from that kind of event with something cheaper and just keep trading in and out of them as the tweets come out, right? It pops, you sell them at a profit. News settles down, you go out, you buy something inexpensive again, he sends out another tweet, pops, you cash out at profit again, and so on. You can play it that way.
And Tom says, what percentage of your account are you protecting with the insurance?
So again, there's a couple things. So when in the next segment, we'll talk about how to protect individual positions. And so in a sense, you should always have protection anyway, because the way you structure each trade offers you a certain level of protection. But otherwise, it comes down to how confident you are that things can go against you, right? So if I'm convinced we're going to see a pullback, right? But based on the charts right now, like I said, I only see this one little red flag, right? So I'm not going to go in with a 100% hedge. There's no reason to. I'm not even going to go with an 80% or a 50% hedge. I might pick up a 10 or 20% hedge, right? For what I see here, with the plan to add to it as I see a second red flag, third red flag, etc. Right? So think of it this way: when you think of a balanced portfolio, right, where you think of stocks being the risky component, and you balance that out with some bonds, right, some money market funds, where those other instruments are a lot safer. So during a strong bull market, you want to have probably 80% equities and 20%, those safer components, right? But as the market starts to settle back, you want to go 70-30, 60-40, maybe 50-50. In a downtrend, you want to have more exposure on the bond side than you do the equity side, right? So it reverses. So at what stage of the game are we right now? If you were managing a portfolio, how do you think you should be balanced right now? Is it 80-20? Is it 50-50? And use that to determine how big of a hedge you want on, right? Because if I'm 80-20 equities, I'm not thinking about hedging myself very much, because I think the risk of that happening is very little, right? As I'm reading the price action and I'm starting to get a little more nervous, the percentage of that hedge goes up.
Okay, Bob says, last question on this weekend hedge. So buy one strike out of the money for VXX or SPX calls and go further out of the money, or go in the money, say a 70 delta.
Okay, so we're going to have more of a discussion on this next with the options, but let me put it this way. Your probability of making money and that option ending up in the money is obviously much higher with the in the money options than it is out of the money. Having said that, you're spending more, so you're risking more. So if you want to spend less, risk less, you have to give up some of your profit potential, which means you go out of the money, which you're less likely to turn a profit on. So options, it's a real balance, not just between the time to expiry and the cost, but the probability of it working out. So the less likely it is that it's going to work out, the cheaper it is. That's why, to Tom's point, because Tom just said, but the cost of insurance is currently so cheap. So could you buy options and roll and roll and roll? Yes and no, but the reason why it's cheap right now is because things look so bullish from a technical aspect, right? So that's why it's cheap, because the likelihood of you ever needing or using that insurance are slim still at this point, right? So in all likelihood, even though you're only spending those 50 cents compared to $3, chances are they're going to expire worthless and you're going to lose your 50 cents because things still look decent, right? So as that picture changes, obviously then they get more and more expensive. So it's cheap when you don't need it, because chances are you're just going to throw it in the garbage anyway. It's just going to expire worthless on you. When you really need it, of course, it's going to be more expensive. So the key to all this is to have an edge over most traders, which is know how to read the price action and recognize that tipping point, because most people won't. Most people only look at their statements at the end of the month and go, oh my God, what happened here? Geez, I think things aren't really turning around. Well, a third of it is already gone. So at that point, insurance is already too expensive. But for your in the money and out of the money, it's the same sort of thing, where out of the money, you're less likely to ever exercise, because the chances of it going from being out of the money to in the money is a lot less likely. As where in the money, yeah, your likelihood of making money on that trade is always much higher than buying out of the money, but you're going to have to pay up for it. So how confident are you? So if I'm thinking from a hedging perspective right now, where the market is telling me I don't really need much of a hedge, for me to go out and spend more money on that in the money hedge, right, doesn't exactly make sense to me. I'd rather buy an out of the money That way, if some unexpected event happens, right? Like China fires a missile or something and says, screw this, not only are we not making a trade deal, we're going to war. Like something that no one would expect, that out of the money option is going to be worth a lot because there's going to be a huge reaction on the market by the unexpected event. But if things go as expected, it's going to be a slow turn, even if it starts now. It's going to take a little while. And so, I have time to then jump into an in the money or pick up more contracts of the out of the money, etc. Put a bigger bet on the table. But I wish there was what's the word I'm looking for? I wish there was a more of a hard and fast rule to say this is exactly when you go in the money or this is exactly when you go out of the money. But it all comes down to that prediction. Now, the one thing you need to keep in mind is if you're going to buy out of the money, it's how far out of the money. That's the real question. And so you never want to go so far out of the money that there's never a chance that underlying stock has a chance to get to being in the money by expiry, right? So if you're looking at something like Apple, right? So it's at 271 right now. That's where it closed, right? Or 270.71. So if I'm going to buy a $280 strike, what's the chances it goes another $10 move? Very high, I'd say, right? So even though I'm out of the money, I'm being very realistic with the strike price. The chances that it ends up being in the money on expiry are very high, and therefore I should make money. But if I say, well, the 500 strike is only trading for 2 cents, so I'll pile in and buy 1,000 contracts of that. Chance of me ever making money on that are next to nil, because what are the chances this thing doubles in price by that expiry date? Slim to none. So that's an exaggeration, of course, but you get my point. There's a balance, and so in the next section, I'll talk about the Greeks and how you can use them to try to figure out exactly what strike and what expiry you choose.
All right. We are just at 42 minutes past the hour. We are doing great. We're a little behind on timing, but you're powering through the material here. Why don't we take a short 10-minute break? We'll make it an 12 minutes, so we come back at 5 minutes to the hour, and we'll get started with trading with options at that time.
Sounds good.
All right, we are back. Vince, can you hear me?
Yes, I can. I'm here.
All right, we are just about 2 minutes to the hour, and we're now getting into the topic of options.
All right, excellent. So, please let me know if there's something specific you'd like to know about options. But what I was planning to cover, just some basics of calls and puts, and talk about strike selection and expiry selection. Quickly go over debit spreads and the merits of it, as well as what I think are most appropriate for this market, which is the um, married put and collar trade strategies. Okay, so um, when it comes to options trading, the main reason for options are two things. Number one is for speculation, right? You can really leverage your positions with options. And you can risk very little for a big gain. That's what most people trade options for. But for me, I trade them more um, as a method to be a little more conservative, as a risk, being risk averse. I like to spend little and take a small amount of risk. I'm not necessarily looking for that huge payoff, looking for a reasonable payoff, but I'm really trying to find a way to limit my downside, and more importantly, not get surprised like I was with that big loss many, many years ago. In other words, if I say buy a call option on Apple, okay, what that means is I'm buying the right to buy some shares of Apple here at 275 if that's the contract I'm going to pick. Okay. Now I'm paying $10 for that right anytime between now and 76 days from now. But if things go sideways on me, and more importantly, if, like I said before, let's say there's some bad news on the company and we go from 270, down to 130 overnight, right? Is that likely to happen? No, it's not. But, most gaps are not likely to happen until they happen. They do happen, and they happen all the time. So if something like this were to happen and I own the stock, that would be one heck of a loss, right? That'd be a lot of money on the line. But if I only own the option contract, then the most I can lose is what I paid for it. Okay. So that, in essence, is a way for me to control the amount of risk that I have. So if I'm going to go out of the money and say buy a $300 strike call and I'm paying $2.50 for it, yes, that's $2.50 per share, but it's a big difference compared to paying $270 a share, right? So the amount of risk I'm taking here is very, very little compared to what I'm taking if I buy the actual stock. So that's the main reason why I trade options, and they still give you that opportunity to make money if you're right on the direction, but you do need to be right on the timing. In other words, you have 76 days here. If the move doesn't happen during that time, it happens after that, you don't get to participate. So it is a little challenging that way, but absolutely, there are many, many reasons why you would want to trade options. For me, ever since I learned how to trade options, I hardly ever just buy stock. I mean, and if I do, I marry it with a put, right? The only way I would buy a stock outright is if it's a penny stock, right? I'm paying $2 or $3 a share for it, similar to an option contract. So then in that case, it's like owning an option contract without an expiry date. I just own the shares. So if I'm willing to risk that amount, something that small, I'm willing to risk it all. So I just buy and hold the stock, right? But anything, over $10 a share, I would never buy the stock without marrying a put to it. Okay. So I do see a couple of suggestions here: butterflies, iron condors. Those are a lot more complicated. I can touch on those a little as we go through this. And Spiro says, Vince, can you expand a little when to sell right options? When would you use this type of strategy? Okay, so let's get to it. First of all, call options obviously give you that right to buy the stock at a specific price on or before a specific date or expiry. Puts give you the right to sell a stock on or before a specific date at a specified price, which is the strike price, okay? So if you think something's gonna move higher, right, you buy a call options. If you think it's gonna move lower, you buy put options. And a good way, a simple exercise that most people don't use when they try to determine what strike to buy or what expiration to buy, is by looking at the chart and saying, hey, you know, if I'm going to buy the $300 strike call on Apple, right, that's about a $30 move from where it is now. So if I say I'm going to buy the option that expires 76 days from now, right, how many times before has Apple moved $30 in the 70-day period, right? So if it happens all the time, then yeah, that makes a lot of sense, right? That sounds reasonable. It can do it again. But if the stock, you know, moves maybe 5 or 6 points in any given month, one way or the other, for example, right? What's the likelihood that in the next 70 days it's going to make a $30 move, right? Or more than that? Unlikely. So you got to be reasonable with your strike selection and the amount of time that you buy. So when you're doing that, first of all, you want to collapse your option chain and not only look at the different series that you have here, the different options, but you want to look at the far right. And at least on Thinkorswim, they have these two columns here. One of them, the percentage column, is the implied volatility column for each strike each month. And the number in brackets is the market maker expected move by that expiration date, okay? So that alone can tell you if you're being reasonable or not. So going back to our example, if we're buying the $300 strike and we need this to make a $30 move minimum to be in the money, the market maker expected move is 28.98. Okay, so about 29 bucks. So obviously we're on the upper edge of that, right? Maybe we want to bring it down and go to 295, go to 290, make it a little more reasonable, right? So this is a very good gauge. They are very good at calculating this. Obviously, it doesn't always happen, but it's a good measure to use. The implied volatility number here, or measurement, every stock has sort of an average, and you can see Apple is in the high 20s, right? 27 to 29% more or less, right? On average. So if you see one of these contracts, say trading at 40%, 50%, 80%, something way out of the norm, that means for whatever reason, that contract has gotten a lot of attention and is now what we would consider overpriced, right? So typical to see on an earnings event, right? As you head closer to the earnings date, the implied volatility of the strike that will, the expiry date that will happen just after that earnings event, we'll see in most cases a spike in implied volatility. So if this was going to, if there was an earnings announcement in February, this number as we head into February would go up to 40, 50, 60, sometimes over 100%, okay? So if you're just buying it at those elevated levels, you're overpaying for that contract. So you want to buy the option contract when it has low implied volatility, but certainly one of the advantages as you head into one of those events is to experience that implied volatility spike once you're in it. So if we bought this when it had 29% implied volatility and it spiked to 60%, the premium on our option would be much more expensive by then, right? Which means we would have made a nice profit even if the stock didn't move. So it's good to buy low implied volatility and sell when it is high, okay? So Spiro, going back to your question, when is it good to sell an option? It's good when it has a very high implied volatility spike. Now, that doesn't mean you sell it and sit through it during that earnings announcement. That's not what I'm talking about. I think you know that. But if there's a period in the markets when things are very volatile and implied volatility is generally high, but you get a setup on the chart, for example, where this looks to be going higher, right? But that implied volatility is very high. Great time to sell a put against it, or a put credit spread. That way you're collecting that high premium, but due to the chart setup, if it does go higher, that's going to end up being worthless, which is great for you, right? You sell it high, you buy it back at next to nothing, right? And you keep the profit. So selling an option when it has a high volatility, implied volatility, is the best time to sell that option. All right. You can use a credit spread. At the same time that you buy those long calls, you sell a put credit spread. Or if you're buying puts, you sell a call credit spread. You can do it based on the charting pattern as well, but your real advantage is when you're looking for that implied volatility crush and collect that higher premium. Okay, so a spread is a bit more conservative in the sense that you're buying one call option, for example. Let's say I wanted to buy a call here for February, okay? And let's say I wanted the 290 strike, but 460 to 475 is a little rich for me. I don't want to spend that much. Maybe I have a smaller account, and for me to buy one lot of that would be like 30% of my account rather than 5% or less. So it doesn't match my money management plan. I need to find a way to pick some up cheaper. So what are my options? I can go out and say buy the $315 strike for $1, right? That'll match my money management plan, but it's too far out. The likelihood of Apple getting to 315 is unrealistic. So I'm kind of setting myself up for a loss here, right? So it doesn't make sense. So another way to do it is to put together a spread where you're buying a call and you're selling another call against it, right? So say I buy the 290 for 470 or so, and I sell the 295, right? Now this is a wide spread, but let's say I sell it for 370. Okay, so I'm paying 470, collecting 370. The difference is $1 that I'm spending. That's my total risk. So now that matches my money management plan. I can afford $1, right? And if Apple goes higher, I will make money on that, but my profits will be capped, meaning there's a $5 wide strike. So if Apple does move higher, I can exercise this, buy the shares at 295, right? Sell them at 300. That's a $5 difference. So I make $5 profit minus the $1 that it cost me to set up the position. I have a $4 maximum profit potential, right? As where if I just bought the 290 outright and the stock ended up going above 300, I can make a lot more money there on the single contract. But the debit spread lowers my risk, lowers my expense, and still allows me to play that stock and potentially make a decent return, because making $4 for every one that I risk That's still very, very good money, right? Another thing, and I don't see the name here. All I see is OM. But someone is saying, would it depend on the ATR to buy a call $0 out in 76 days? So yes, that's another great way of doing it. So the average true range, it's an indicator you can throw on your chart here. ATR, that's what it's known as. Average true range, that's what it stands for. What that means is that's the amount of movement the stock does from high to low, and it depends on your time frame. So if it's a daily time frame, right, that number you see on the right here, 414, it means right now, on average, over the past 14 trading days, if you average it out, Apple moves about $4.14 from high to low on any given day, right? So if it had a nice push higher over the next 76 days, right? How far can it move? What's realistic, right? So the ATR is another good gauge to use. I like to use ATR more when day trading than when trading swing trading, because you need movement during the day, right? So if you're going to go down to a 1 minute or say a 5 minute chart, you can see that the ATR now on the 5 minute chart is 23 cents or something right now on any given bar, any given 5 minute time frame. So that's not a whole lot, right? So you need something that moves. And so the ATR is a great measure for that. But yes, you can use that for your strike selection as well and your expiry date. Absolutely. Thanks for that. So Nilash, yes, for options trading, the timing and the direction, you pretty much have to be right on both to make money. Now, there are certainly exceptions. One is with that implied volatility spike. So if I pick up shares of Apple here and the stock just kind of goes sideways for a few days, but the implied volatility spikes because of an announcement that's coming, the option premium will still go up and I'll still make money, even though the stock didn't really move. But if the stock moves at the same time that that implied volatility spike happens, I'll make even more money, okay? But generally, yes, you have to be right. See, that's the challenge. So trading options compared to just the stock is safer because you're risking a much smaller amount. You can't lose any more than you put into it. And, it's much safer. But you have that expiry date that's challenging. So if I just buy Apple stock and it doesn't really move over the next 76 days, but it does over the next 90 or 120 and so on, I'll still make money. Yes, I have to hold it longer, but I'll end up making money. As where over the next 76 days, if it really doesn't move, my option expires worthless. I lose all my money. And then the stock does continue higher and, I sit there kicking myself, right? So it's a combination of the two that really matter. And so it comes down to how big of a move do you think it'll do realistically, and according to your money management plan, the size of your account, etc., how much can you afford, and how much risk you want to take. So remember, going in the money always gives you a higher probability of profit. And maybe I should explain the Greeks a little. So there are the Greeks, the delta, the vega, the gamma, and the theta. Delta here is the measure, and it's this row here. I have too many columns here to show you. The delta is the measure of how much your option price will change for every $1 move in the underlying stock. So if I'm selecting the 280 strike and I look at the delta column and it's a 40, a 0.4, that means that for every dollar move in the stock, my option price should change by about 40 cents. So if Apple gains $1, my option should gain 40 cents. If Apple loses $1, my option should lose 40 cents. Okay, and that's a dynamic number. It'll move, it'll recalculate after every dollar move. So if Apple goes up $4, right, it'll be 40 cents for the first dollar, maybe 44 cents, right, for the next dollar, and so on. So the deeper in the money this becomes, the bigger the delta, right, up until 100. It caps out at 100, right? So if you look here, as you go into the in the money columns, it just goes higher and higher and higher, right? If you're going out of the money, it goes lower and lower and lower. So that's the other difference. If I'm going to buy that $300 strike, the delta is 0.18. So for every dollar move Apple gains, I'm going to gain 18 cents. So if I'm only expecting a $5 move in the Apple stock, because let's say we're looking at the chart here, and yes, it looks like it's going to break out, but let's say there's resistance up here, $5 away. So I think, yeah, $5 move, that's what I'm looking for. Well, then if I buy the $300 strike, it's $5 times 18 cents, right? That's my potential profit per share, right? As opposed to 5 times 40 cents per share, right? So you can see that the deeper in the money you go, the more money you will make, right? So the way I look at it is, if I'm expecting a small move, a limited move on the underlying stock, I want to go in the money because I want to maximize my profit. So if I can make 71 cents for every dollar, I'm still making several dollars of profit by the end of that $5 move, right? But if I'm expecting a much bigger move, so I'm expecting that $30 move on the stock, it makes more sense for me to go and buy many more contracts of the 18 strike, because by the time this moves $30, this delta goes higher and higher and higher with every dollar that it gains, right? And with more contracts, by the end of that $30 move, I'll end up making a lot more money than, say, having only one contract of the 70 delta. So that's your trade-off. You always have to look at how big of a move you expect the stock to make in how short of a time period you expect it to make that move. Those are all decisions you have to make. But generally, the sweet spot for your delta is, for a smaller move, you want to look at the 65 to 70 delta strike price. And for a bigger move, you want to look at somewhere between 20 and 40. Okay. Try to keep it above 25 to 40, really. In there is where you want to buy for a bigger move. There's no point going out to, below 20 in delta. All right. And so let's see now. You have, we can get into more specifics, but for example, the gamma is the measure of how much your delta is going to move for every dollar move in the stock, right? So if you have a high gamma when you buy that option, that can affect your position as well. Because if the stock doesn't move much, even a smaller move with a high gamma could affect the delta quite a bit. Okay, so if the stock pulls back, say 50 cents, but you have a very high gamma, right, then that could really lower your delta overall. And then when it starts to move in your direction, you're not making as much money anymore. Okay, so you can look at those things as well, but the two main Greeks are the delta and the theta. And the theta, what the theta measures is how quickly your premium will erode as you get closer to expiry. So if we have 76 days to expiry and we have an out of the money strike, okay? So if we pay $8 for this 280 strike, that's all time value. There's no intrinsic value. Every option is made up of two portions, an in the money portion and an out of the money, an intrinsic and an extrinsic value. So let's say we go in the money, the 260, right? We pay about $19 for the 260. Now, if you add 19 to 260, right? You get what, 279? But the stock price is at 270, right? So the difference is that the first $10 are real value, intrinsic value, from 260 to 270. That's the in the money amount. The $9 from 270 to 279, that's time value. That's based on the 76 days to expiry. And so as we get closer to expiry, the $9 will erode, will diminish. So with every day that goes by that the stock doesn't move, right? But we get 1 day closer to expiry, the time value will shrink, okay? So obviously the final 30 days, as you get closer and closer to expiry, that's when the bulk of the erosion happens, okay? As long as you have more than 30 days to expiry, the erosion is quite slow, but in the last 30 days, it's pretty rapid. So you have to take that into account as well, because if the stock waits 74 days before it makes a move and makes all its move in the last 2 days, right? You've already lost the time value, okay? Those $9. So even though it doesn't make a move, even though it doesn't go against you, but if it doesn't move in your favor quick enough, you'll lose the time value, okay? It'll erode. So the smaller the time value, the better. And that's why the deeper in the money you go, the less there is, the less you have to worry about theta. But of course, the more expensive it becomes. It's a trade-off, right? And so that's the issue. Now, when you want protection and you want to buy the stock, especially if, say, it pays a dividend, okay? So you want to collect the dividend. You also think the chart looks good. The stock's going to continue moving higher. So you want to own it, but you don't want the risk associated with it, because at any time, whether it's a tweet, whether it's something completely unexpected, the market can turn quickly. And if you have no protection, you can lose a lot of money. So you can put on a hedge like we were talking about earlier, or another way to protect the stock is to buy a put option, right? So if I buy the stock at 270 and I buy a put option with a strike of 280, right? This gives me the right to sell my shares that I bought at 270 for $280 anytime between the day I buy it and the expiration date. So for the next 76 days, I can sell my shares at 280 no matter what. Anytime I want, press of the button, I sell my shares at 280. Now, I paid, between $15 and $17 for that right, okay? So if I paid $16, let's say, for that right, I paid $270 for the stock plus 16, that's $286. So I'm not going to go and sell my stock at 280 if I paid 286, right? Unless it was above 286, right? So if it gets to, if it moves above that, I can just sell my stock and get rid of my put. So in other words, my break even is 286. If the stock moves to 290, right, I can take a full loss on the option and still make a $4 profit on the position overall. Makes sense? But if it goes against me, let's say there's that gap. Went from here, next day it opens at 130, right? I'm not losing $140 a share, right? all I'm losing is $6 a share, right? Because I paid $270, I paid 16 for the option. That means my total cost, my break even is 286, and I'm selling it at 280. So even though the stock dropped $140 a share, I'm only losing $6 a share. That's your insurance. That's your insurance. And this is the kind of thing you want in place now. Because we don't know what's going to happen. Not tomorrow, not in 2020, not in 2021. We have no idea. We think it's going to drop. But for now, while things still look good, we don't want to stop trading. We want to take the setups that look good. And, but if we can afford to buy that protection, to buy the underlying stock and marry a put with it, then we can take advantage of both. We can make money as it goes higher, but we're also protected and lose a very small amount if it turns against us quickly, right? And drops. If you want to add one other piece to it and turn this into a collar trade, you can sell a call against the shares at the same time, right? So you own the stock, you own the put, and then you turn around and sell the shares. Now look at this. If I buy the shares at 270 and I buy the 280 strike at 16, let's say, okay? That's 286 more or less my cost. And I have the right to sell it at 280. But now if I go to the call side and I sell a call for $7 or $8, that lowers my cost. Sometimes it'll lower the cost below the strike price, because if I can get this for 16 and my cost is 286, and then I sell this for almost 8, right? Let's say best case scenario, I can sell it for 8, right? Now my cost is 278, right? 286 minus 8, that's 278. But I have the right to sell it at 280. So not only don't I have any, I've already guaranteed myself a $2 profit per share doing it that way, right? And now, because if the stock goes up, I get called away at 280, make a $2 profit. If it goes down, I exercise at 280, make a $2 profit, okay? Now, you're not always going to find it where you can lock in a profit, but you can certainly find it where you have a very small amount of risk, right? And still allow yourself room for profit, okay? And you can buy yourself a lot more time by doing that. So for me, in this kind of environment, and especially if it's a dividend paying stock, I buy the stock, marry the put to it, and then wait, because I have my insurance policy. And if the stock goes up, what's going to happen to the call premium, right? It's going to go higher. And then I can sell the call against and collect even more premium. So you can leg in. You don't have to buy it all at once. You can leg in, okay? So that allows me to continue to make money in the market if it continues to go higher, even though, I can't understand why the market would go higher. I think we should be collapsing right now, but it doesn't matter what I think. What matters is what's happening with these buy and sell orders. And so if people continue buying, that's okay with me too. I'll continue making money. And when things turn, I have my insurance policy and, the potential to lock in a very small amount of risk or even a profit. So those are the ones that I would focus on. You can play with butterflies and iron condors and all the different types of option strategies out there, and there are many. But I would do one of two things. I would continue to buy straight call options, because especially when they're inexpensive, they offer you a small amount of risk for the potential for a good return. You can switch to debit spreads instead of straight calls or puts as a way to minimize your costs, lower your risk. Yes, you're capping your upside, but you're still leaving yourself room for profit. So that's another way to be a little more conservative. Or if you have the capital for it, I would buy the underlying stock, marry the put to it, and when it makes sense, sell the call against it. Okay? That way you can sleep soundly at night. You don't have to worry about any unexpected event happening and driving the market against you. And you know that if all your positions are set up like that, even if there's a catalyst that causes the markets to crash overnight, the amount of pain you're going to feel is very, very minimal, right? So you're very, very safe that way. And at the same time, when the charts give you those hints, you can start putting on those hedges as well for a very small amount of money. So that's the way I would trade the markets right now. Because yes, from a technical level, they still look pretty decent. I still want to continue to trade and take trades to the upside, but I'm just uneasy with the fact that it can turn at any moment. And although I'm looking for clues, I want that extra insurance and I'm willing to pay for it. So any questions on that before I talk about iron condors and butterflies?
Bob had sent in a question by email. He says, on options, I'm somewhat confused as to the optimal strike to buy. In the money, 70 to 80 delta at the money, or just out of the money, or for far out of the money. I have a friend who will only buy directionally 70 to 80 deltas, 3 to 6 months expiry. And I have other friends who do out of the money directionally. Your thoughts?
Yeah, so exactly what I had said before. It really comes down to how big of a move you're expecting and what kind of time frame, right? So if you want the probability of making a profit, you go with the in the money. That's where your safest component is, but you're gonna have to pay more. You're gonna have to take more risk. So see, I love options because they allow me to spend a lot less than what I would pay for the stock. I mean, you look at Apple, compared to $270 a share, I can pick up an option for 10, for 8, for 4, right? And spend a lot less. But be careful with how you set up your order, because if you're thinking, I pay $10 for this option, right? But, I'm putting my stop here. So if I'm buying here, right? And I put my stop here, and let's say, whatever, it's a $10 move with a delta of 40. So that means I'm risking $4, right? So if I pay that option $10 and I'm risking 4, that means I'll get out, when the option is $6, I can take a $4 loss, right? But what if it gaps and comes down here, right? So there's always the risk that you can lose the full amount of your option premium, okay? If you pay $10 for that contract, you can and sometimes will lose the full amount. So don't base your risk profile on the amount from entry to stop. I always base it on the full amount, okay? So you can be a little more aggressive by basing it on the stop amount, but to me, I never forget about that potential for the gap. So I will look at, am I okay with losing the full 10 if that's what happens, right? And if I say no, that's going to be 20% of my account, well, then I will never do that, right? So be careful with your options, because it's a lot easier to say, well, they're fairly inexpensive anyway. Plus, with my stop there, I'm not going to lose the full amount. So I got very little risk. So let's buy a few more contracts. Be careful. Do the math before time, ahead of time. Go ahead.
Penn says, so a married put is just buying a put and buying the shares, and you collar it by selling a call. It could pay for the put. Am I understanding this correctly?
Yes, you are correctly.
Okay.
So alone, the stock with the put, that's a married put position. A collar involves all three sides. You're buying the call, you're buying the put, you're buying the stock, you're buying the put, and you're selling a call against it. Now you can do it all at the same time as a call, or you can leg in. You can buy the married put first, the stock and the put, and then wait to see if you're right. If you are and the stock goes up, then you can collect a lot more premium on the call side, right? And lower your cost basis more, lock in a profit quicker. And then continue to hold the trade and see if you can squeeze out even more on it, right? The other thing too is exactly that. If you want to pay for the option, you can set up your married put in a different way. Here, let me give you a different scenario. Let's say you bought the stock at 270, but instead of going in the money on the put side, you go out of the money, right? Let's say we're going to come down and buy the 250 strike, okay, for $10. Oops, for $10, okay? So if we go here, we can sell the 300 call for 10 and use that 10 to buy the 250 put. So now we're still only spending 270, the same as we would have if we're just buying the stock, right? What does that mean? That means that if the stock drops, goes against us, right? Remember, our cost is still 270. I have the right to sell it at 250. So if it really crashes and goes below 250, I can always get out at 250, right? But I still have a $20 risk on the table from 270 to 250, right? So I have more risk on the table that way, even though I'm spending less money initially on that full position. Remember before, by buying the 280 and, you know, it was on the February contract, but we were only paying like 16 bucks for the option. So our break even was 286. We had 280 to sell. We only had a $6 risk. Here we have a $20 risk doing it this way, right? But the other thing is that you can adjust these positions, okay? Another great benefit of options is the adjustments that can come with it. So let's say I buy the July 250 strike at $10, okay? I sell the call for 10, so it's paid for, right? Now, let's say that Apple drops, okay, in the first 30 days, let's say it drops. Let's say it comes down to whatever, 260 or even 250. Now, what's going to happen to my call option that I collected $10 for, that I sold $10 for? It's going down in value because the stock is dropping, right? So let's say it goes down to $1. I can buy it back and I've locked in a $9 profit on the call on its own, right? The put will increase in money because as the stock drops, the put increases. So the put now might be worth 20, right? So I collected 9 here, I collected another 10 there. I've made 19 bucks, right? But I've lost probably an equivalent amount, if not more, on the stock. So I'm still in the hole, but slightly, okay? So that's the other benefit of structuring it this way. Number one is it can fluctuate back and forth, and you're never going to get really hurt badly because you know what your risk parameters are ahead of time, but you can make adjustments. So now the other benefit is here that these puts have an element of time in there. There's 223 days to expiry. So there's a big portion of that is time value. So the way we can benefit from that is by selling these and buying the same strike or higher with less time. So let me show you what I mean. Let's say that we had bought Apple and at a higher price. And now it's come back, and we initially had paid like $3 for the puts, but now they're worth 10 because the stock had dropped. Okay, so now, yes, we're in a hole on the stock, but if we sell this, we collect $10. Let's see what we can buy for the exact same amount on a lower strike. So if we go to the February's and we try to spend $10 on the put side, what kind of strike do we get? Well, we get about 265. Remember that one was 250? So we can buy a strike that's $15 higher with the same amount of money. So we're not putting any more money into the trade. We're just selling off our time value. Instead of 223 days to expiration, we now only have 76 days. But we've moved up $15 in strike. So we've eliminated $15 of risk by doing that. You see? So a lot of times when you buy more time to expiry, even if the stock starts going against you, if you start seeing that like this, and oh, put in a lower low and now you want to get out, it doesn't mean you're going to take a big loss, because you can sell your time value, move to the lower strike, and move up in strike with the same amount of money. Does that make sense to everybody? I know it's difficult to follow sometimes when I'm just pointing on a option table, but does that make sense to everyone? So if you're moving closer in on expiry, you're giving yourself less time for the trade to play out, but you're eliminating risk without putting any additional money into the trade. So although at first glance it may seem like, wow, I've got $20 of risk on the table, you actually don't, because you can actually adjust that, right? So when you think of, hey, Apple looks good right now, but if the whole market rolls over, Apple will go with it. What can I do to protect myself? This is exactly the kind of thing you can do, right? So say you own Apple in an IRA that you've been holding for many years. You don't want to give up all that profit. Go in and buy yourself a put with lots of time to expiry there. And if you need to, pay for it by selling a call, right? But then if Apple starts to turn, buy back the call at a profit, sell this put for whatever it's at the moment, and use the same amount of money by going to a near-term strike and buy a higher strike so you can get out of it at a better price. Got it? I don't see anyone typing, so I'm wondering if...
I don't see anyone typing either. Bob says, can you help me again, knowing which call is a better deal?
So again, it's a balance between how much risk you want to take and how big of a move you think is realistic for the stock to make, okay? So the better deal, you know, if we're just looking for a better deal, we can say, hey, go way out of the money and pay the least amount, that's a better deal. But it's not when you look at probabilities, right? The probability of it ending up in the money on expiry, the farther you go out of the money, the less chance there is of that, right? So your delta, you can use your delta to judge that. So if we look at the 310 strike, which is an 11 delta, that means there is an 11% chance that 76 days from now, Apple will be at 310 or higher. But if we look at the 265 strike, there's a 60 delta. That means there's a 60% chance that 76 days from now, Apple will be, right, at 265 or higher. So the deeper in the money you go, the better the chance you're going to make money on that trade, okay? But, of course, the more you're going to have to spend. So do I really want to go and risk $33 or $34 a contract here for an 83 delta, right? Probably not. So it's a balance. So again, if you think the stock is going to make a modest move, just a small move, say you're expecting Apple to move $5 or $10 over the next few weeks, right? You want to go in the money so you make as much money on that trade as possible. If you're making 70 cents every time it moves $1, right, and it moves $5, that's still several dollars of profit. But if you're only making 11 cents for every dollar it moves and it only moves $5, how much can you expect to make, right? Not a whole lot. So you only want to go out of the money when you think the move can be sizable, right? And you never go too far out of the money. You want to stay 20 delta or above, and 25 to 40 is really sort of the range where you want to be at. And 60 to 70 is where you want to be at in the money, okay? But it all comes down to, when you're looking at the chart and you look at the setup, determine how far can this move? And you can determine that by identifying levels of overhead resistance, if there are any, which will prevent it from going any higher. You can draw your fib extensions that'll tell you how big of a move you can expect. If it's been consolidating for a while and then it breaks out, you can measure that area of consolidation, and you should expect a similar move in the upward direction. There's many ways to look at it, but that's what it comes down to. I hope it helps.
And Spiro says, I usually check the Fibonacci levels before deciding which strike price to use. Any thoughts on this strategy?
Yeah, the fibs are always great. The fibs are great both from trying to determine how big of a move it can make, to also identifying where support below in case it doesn't go your way, right? So we can use both the fib retracement and the fib extension tool and figure out, so if we take the fib retracement tool, right, say from here to here, if it goes against us, you can say, well, back at 256, there should be, again, it should find some support there, right? So I know, how far it can go against me before it finds some kind of support. If you want to take the fib extension tool from here to here, then you can say, well, here's realistically where it should go next, from 271 to 277, then 289, then 320, right? That's where it's going to have that potential to stall out when it hits those levels of resistance. So it's a fantastic tool. Fibonacci's are great.
Bob says, say on Monday, market rally starts to tank. Trump trade tweet, you want to profit via a day trade with some market puts, or maybe 2 to 3 days swing trade. Vince, what strike would you consider buying, and what expiry for a quick day trade, say next Monday?
Well, first you would look for weekly options. There's no point in going out and paying premium for an option that expires 76 days from now if you're only going to be in it for 2 or 3 days, right? So now this one here doesn't have, well, yeah, it does. Here are the weeklies, right? So I might buy the December 20th for 13 days out to expiration, and you can see that these are going to be a lot less expensive, right? First of all. But again, it comes down to how big of a move do you think it can make. So the only way you're going to be able to judge that is by looking for levels of support resistance, or the average true range, right? The ATR, which will give you an idea of how much it's been moving over the last 14 days, right? So if we look at that and say 3 days, an ATR of 4, 3 times 4 is 12. That's best case scenario. That's if it drops, say, the full $4 a day, right? $12. Now, how does that line up according to areas of support and resistance, right? So we're at 270. $12 brings us down to about 258, right? So is there some more support there that could help hold it there, or whatever, or what's most likely, right? So those are the things you have to gauge to say, if a tweet does come out, what's the potential with Apple here? Just like if it's a positive, a tweet that moves the markets higher, right? How far can it go? If there was a strong level of support here, an overhead resistance here, which is like 8 points higher than where it is now, right? doesn't really matter how strong the tweet is. You know, you've got about an 8-point move. So that's when you go to your delta and you say, I think it's going to happen over the next 2-3 days, so I'm going to buy the weeklies. I'm expecting an 8-point move. You know, if I buy the 265 strike, 70 delta, 8 points, you know, that's a good sized profit, right? 70 cents for every dollar it moves. That's really good. If I'm going out and buying the 295 strike and it has a delta of 2, then what's the point of me buying these when I'm expecting 2 cents for every dollar move? 16-cent profit, not worth it, right? So, you know, that's what you got to look at. An $8 move, does it line up 270 to 295? No, that's way too far, right? Or a drop, I should say, on the put side. You need to find a strike that's within that $8 move, something that could be in the money by expiration, okay? And with little to no time value. As when you're playing the short terms ones, the ones that are 30 days or less to expiry, the theta decay is going to be an issue for you. So let's say I thought it was going up over the next 30 days and I wanted to buy the 280, right? 90 cents. So I'm thinking, wow, that's not much, right? But let's say over the first 3 days, Apple just kind of goes sideways. This isn't going to stay at 90 cents. It's going to keep dropping. Every day it's going to drop a certain amount because it's really close to expiration and it's all time value. There's no intrinsic value. It's all out of the money, right? So you have to gauge that as well. So Bob, your best bet is to look at in the money with a weekly option. That's what you want to do in that scenario.
All right, Vince, let's take a 10-minute break before we bring it home with the last segment starting at 5 minutes past the hour.
Okay, excellent.
All right, we are back for the big finish. Vince, are you here?
Yes, I am.
And what last little bit of wisdom are you going to impart on us?
Well, just some strategies, some simple strategies to use. I'll touch on the 10 period moving average, the pencil ruler method, and go through veracity and show you some different platforms.
All right, let's get to it.
Okay, so someone mentioned it earlier. I can't remember who it was, so sorry about that. But the 10 period moving average. Um, I love using the 10 period moving average with a monthly time frame. Now, you don't have to use it on the highest time frame, but certainly I think it's most accurate there. And it's a very simple way to gauge whether you're in a bull market, a bear market, or something in between as well. If you see here, we have a chart of the SPYs, the S&P 500, going back to the year 2000. And you can see that with a 10 period moving average, price spends the bulk of the time on one side or the other. There's very few areas where we kind of chop around from month to month through it. So we tend to trend long periods of time through there, so either on one side or the other. So it's a very easy and quick way to spot the overall trend. And it's honestly a very simple way to manage your trades. It takes very, very small amount of time. So if you ever have or see a stock where, there's an upsloping 10, for example, and price moves just below it and back above, I mean, those are great entries along the way. And you don't have to hold it for, years on end. But I mean, you can, especially if it pays a dividend, but you can participate in just a portion of that or just use it as a guide, right? So for example, throughout here, we were clearly in a bull trend, so I can move to the daily chart at that time and only look for long setups, because on the daily, it is going to fluctuate back and forth, as where here, it's a slow, steady grind higher. So the 10 period moving average on a monthly time frame, regardless of what you're trading, whether it's something like oil, gold, the dollar, stock, it really doesn't matter. And it's so easy to spot the start of those moves. And if you thicken up your moving average a little, like I've done here, you can see that when they're just kind of consolidating, it's hard to see the candles. Like it's not clearly on one side or the other, right? So it's kind of obvious to stay away from it. But when you can clearly see the candles like that, or you get an opportunity like you did here on Amazon, where it dips for a month and closes back above, that's a fantastic entry. Okay. And for now, so far, we're still nicely above that moving average on the index charts, right? So even the Russell is back above there. And so it's a great way to use this. Now, you can certainly add things. See, going back to indicators and oscillators and so on, they're helpful from a visual and a confidence standpoint. So let me show you one that I think here. Let me put it on here. LBR paint bars. Okay. Now, I don't know who created this or whatever. It's sort of like the Heiken-Ashi candles, only it doesn't change the candles at all. It just changes the color of the candles. You can look at the TOS definition of it and so on to get an idea of what it does. But it's basically identifying areas of a strong trend. And you can see here that those times where it goes higher, it's clearly picking up that strong trend. maybe a little later than we would have with just a cross above the 10, but visually, it just helps support what you're seeing, right? And can give you greater confidence. And these you don't have to use just on the monthly, you can use anywhere on the daily. If you look at the daily chart here, it's the same setup, 10-period moving average with the LVR paint bars. And you can see that clearly, above that 10, you got the green bars. Below, you got the red, green, red. And so, whether you're trading on a 5-minute chart, a 15-minute chart, again, it just supports what you're seeing. And it gives you the ability to remain in the trade a little longer because you're not seeing all those different colors along the way and second guessing yourself, right? So it's important. I don't want to tell you not to look at the candles. It's absolutely important that you read them one by one and understand what's happening. But if you find yourself second guessing yourself, not being quite sure, getting scared out of trades, having something like this that's color coded will most likely allow you to remain a little more relaxed and stay in the trade a little longer. So it's just an idea for me to share. But that simple moving average is really all you need. And again, it doesn't matter the time frame, hourly, daily, weekly, monthly, 5-minute. It just identifies those areas of a nice strong trend. And of course, along with it, you identify those areas of support resistance, you draw your trend lines, all those other good things. But these can give you an idea of when to enter, when to exit, whether it's in a strong trend or not, whether to hold on or not, all those things. So it really is that simple. Now, if we take that off here, I want to show you that going back to the way we used to do things back in the day when we didn't have all these fancy tools, we basically just plotted the closing prices every day and connected the dots, meaning we use line charts, right? So they would kind of look like this exactly, where the points are all the closing prices, right? And those are the turning points. Those are the pivots. So a very simple way to trade that is highly, highly accurate. And it doesn't, I'm showing the weekly time frame here. It doesn't matter. It can be daily, can be 5-minute, can be monthly, whatever you want. The whole point is you pick a moving average like that, okay? And you don't even need the moving average. You can just use the line chart itself. The moving average just makes it a little easier. Because if you're making that shift from higher highs and higher lows to lower highs and lower lows, right? It may complete that before it crosses the moving average. In most cases, it will do it afterwards. And even if it does before, like it is here, see up here on Amazon, this top was pretty clear to see, right? If you look at the peaks, we're continuing to make higher highs, higher lows, suddenly a lower high, right? Actually, we got a lower high here, and then we got a lower low, right? And so, but the moving average, if you didn't notice that switch from higher highs to higher lows before, moving average is like a red flag we crossed below, right? But all you have to do is draw your horizontal lines at every pivot. So in other words, say we're below the moving average, we cross above and we pull back. Your first pivot is up here. So you draw the pivot across the top and you're waiting for a cross. If it crosses, if it moves off to a new high, you buy, right? And you make another pivot here, right? It doesn't even pull back, it continues to go. Same here, same here. Here, you make a pivot, it pulls back a little, right? Now, where's your stop? Your stop is if it breaks a previous pivot low, right? It didn't though. It turned didn't make a higher pivot there, so you held on, comes back. Now here is where it crosses. So you can just continue to hold, or you can even add to your position, right? Makes another pivot high here, pulls back, but doesn't pull back far enough to take out that previous pivot. So this is essentially your stop, right? Doesn't. Now, when you move, when you make a new pivot high and you break it again and you move off again, whether you buy more or not isn't very important. What is that you move your stop then to the next pivot low, right? Which can be just a high pivot there or that little pivot low there. It moves off, creates a new pivot, you draw another line. Why do you draw that line? To identify your next entry. The pullback, does it go low enough to get stopped out? No, it doesn't. It turns, and there's your another entry, and off you go. And you continue that until you get stopped, right? So this one would have pulled back enough to get hit there. So you would have entered here and like 1,003 on Amazon and exited around 1440, right? So, you know, over a 400-point move there. And really, there's nothing to get scared out of. There's nothing to, not a lot of work to do to manage the position. All you have to do is draw these lines across a pivot whenever it does so, right? So then it dipped here, right? So now that it crosses below, right, you're waiting for the first pivot to emerge, and this is it. So now, if this had pulled back up here, right, went this way, and then failed and came back down and crossed it, that would have been your entry to go short. It didn't happen. Instead, you mark the next pivot high and you wait for it to be taken out. It gets taken out, you enter here, you wait for that pullback, okay? Once you make that next entry, whether it would have triggered it or not a big deal, because if it did, you'd get out, but as soon as it crossed back above, you're back in. So you don't miss that upside, right? And you mark your next pivot, okay? And then once this pivot is defined here, you move your stop up. Crosses above, next buy point, and off you go. So a very simple price action based method that honestly it's hard to go wrong with it. And you know, the higher the time frame, the better. But again, you can use it on any time frame. And all you have to do is be diligent enough to draw those lines and listen to the chart. If it hits a stop, get out. If it triggers the entry, get in, and so on. And you know, the higher the time frame charts, the reason why they're better is because you avoid those unexpected moves with the tweets, right? A tweet will move the market on any given day, but it's not going to really affect it on a weekly or a monthly, etc. Okay, but you can manage a position the exact same way, just with a line graph and a 10-period moving average. It's that simple. Okay, so again, it doesn't mean it's not advanced. It means it's simple and easy to understand, but it's what really matters. These are closing prices. This is telling you with those closes whether the sellers are taking control or whether the buyers are fully in control, right? The moving average is a visual aid that just helps you have some clarity with what you're looking at. Okay. Now, having said that, we have programmed, like we said, our various strategies, our winning momentum strategy, veracity strategy, and all of these within the calculation here, within the programming, have all the factors that we're looking for in a trade. In other words, we're looking for a clear trend higher, right? Higher highs, higher lows. We're looking for the buyers to be in charge at the time. And we're determining those things with other indicators, right? Like the RSI, for example, being above the 50 line, the slope in the 20, and so on. So it calculates all those things, and then we'll plot these symbols, which the little diamonds that you see are your setup candles. It's like a heads up saying, hey, there may be a trade coming soon. Don't buy just yet, but get ready. There may be a trade coming up soon. If you see the arrow, that means it's time to get in. And you know, the green symbols reference a long trade, the red point to a short trade, right? So once all the criteria is met and the trade is triggered, from that point on, all the candles will remain green so that you stay disciplined and you don't get scared out of that trade until you see the exit flag, okay? The one thing about the veracity system and the exits that are programmed in here is that it will get you out fairly quickly. So when you take a trade, whether it's a small move or a big move, it doesn't wait very long before getting you on. In other words, you don't usually give up all your profit, right? You usually maintain the bulk of it there, just like here. This was still in an uptrend, didn't really turn to lower highs and lower lows until later on, but veracity got us out here. So in this case, maybe a little early, but we maintained that profit. So there are things it looks at to determine whether that trend is getting weak or not and gets you out immediately, okay? Now, the idea with veracity here with the indicator is not to take every single trade. With the indicator, we send out a training class where I explain in detail which ones you want to take and which ones you don't. Now, for the demonstration, all you have to look at really is the ones that appear when there's an upslope in that 20, an upslope or a downslope, right? So you want to short or buy puts when you get a setup and there's a nice degree of downward slope on that 20. Just like you want to pick up some calls or buy the stock when these arrows appear along an upsloping 20. Those are a no-brainer. You really can't go very wrong that way. You will have many more winners than losers if you just do that alone. But in the training package, we explain exactly when you might want to take a trade. For example, along this area here, when the moving average is flat, there are times where it will identify a breakout. And so not all of these are breakouts, they're potential breakouts, but we cannot eliminate those false triggers without eliminating some good ones based on the formula. So we'll teach you which ones to focus on and which not. But like I said, if you just focus on the ones where there's slope, this does all the work for you. Tells you when you have a high percentage chance of getting in, when you need to get out because things are starting to turn. And I will show you a couple of other pieces quickly here. If we go to the View tab, go to Expert Commentary, there's a nice little box of commentary here that walks you through everything. I always say it's like someone there holding your hand. Because if you look at the chart again and look at the far right, the most recent candle, there's this little black triangle above it. It always defaults there. But you can move that around to any candle by clicking above the candle, okay? Or using the arrows on the expert commentary box. So if we go to an area where there's no trade, like down here, you can see that on the box in the commentary, there's this blank space here because there's no trade. So this will tell you a bit about myself, trading wins and the strategy, but it won't give you any commentary unless there's a setup. So when there's a setup, it'll highlight text in there. And if it has to do with a long setup, it'll be green. If it has to do with a short setup, it'll be red. Okay, so they keep that consistency. And it'll give you a heads up that there may be a trade coming, okay? But it also tells you what you need to look for that trade to happen. And then once that green arrow appears, it'll tell you, yep, it's signaled, and there's a long opportunity, and it goes on to tell you more or less which option you should look at, how far out to expiry, and etc. The delta you're looking for, and so on. And then with every candle that prints as you move through the trade, it's going to give you a suggestion for a stop level. So for example, here, it gives you 190.30. And if we move forward a few candles, you can see now it's bumped that up to 195.29. And we can continue going, and now it's at 197.05. So it kind of trails it for you, and it tells you exactly where to move your stop level. So it kind of holds your hand throughout the whole process and walks you through that trade. And of course, there's a great scanner here. If we go to the top left, the power console here, and go to the Explore tab, top half, you have to select your strategy. So we can select for veracity, setups, or signals. The setups are the little diamonds, which are the ones I normally search for. Gives us a heads up that a trade might be coming. The signals are the ones that have already triggered the arrows, right? Down here, we pick what we want, the Dow 30, the NASDAQ 100, S&P 500. So that's a good spectrum, of stocks there. Pick our time frame, start exploration, and you'll see in a minute, and I have a lot running on my machine. I have like 4 different charting platforms, the GoToWebinar system, all kinds of different windows open, and you can see how quickly it's going through this scan. So 559 stocks, it's going to scan in just a few seconds, and it's going to give me a list of potential trade candidates. Now this is the daily time frame, and there it is. It's done, and it spits them out. Now I can sort them by long trades or short trades. The ones that have a number 1 in the column, that's what they are. So all of these are long trades, except there's a few short here and so on. But I can click on the tabs and sort them by that. I can sort by closing price. So if I only wanted to trade, say, something in the range of $20 to $60, I can take these. If I wanted to go higher up, I could. And then more importantly is the slope. So that degree on the 20 period moving average, right? The higher the number, the bigger the degree. So if we look here at MELI, 16.5. So that's going to have a big degree of slope. Now that might have been a gap, but all we have to do is check it, click it, and then click open chart, and you'll see that on the far side here. Nope, there's that slope, okay? And there's that setup. So now we can go back, look at the chart overall, and see if this is one of the ones we want to take. And you can just go through that like that. Highlight one, click open chart, and there it is. Nice slope there, and so on. Now, you can also cut and paste into a watch list directly from here. You can print them out, you can save it, you can do whatever you want to do. And here are some short candidates, right? So in a matter of seconds here, we have a number of potential trade candidates. So it'll save you a ton of time. And now your job is to go through these and compare and see which setup looks better than another, etc. Right? So it's that simple. So Veracity kind of does all the work for you. And again, if you focus on the ones with a high degree of slope, it's extremely accurate over all different time frames. Okay? Any questions on that? I'm going to show you another platform where we have the exact same strategy here. But just let me know if you have any questions on Veracity at all. Let me bring up the other platform. It's the Tactical Trader platform. And here it is. It just looks slightly different. where we have these green or red circles. And if you look closer in the circle or hover over it, it'll tell you whether it's a setup, a long setup. So sorry, here, the arrow sideways, long setup, right? Then there's long entry, which is the arrow pointing up, and then eventually the exit, right? And again, you have all your watch lists from here. If I just click on one, it'll update it, and top right here, veracity, and there are the signals. Okay? Now you also have a scanner here. Again, you can choose your market. You want the NASDAQ 100, you want the Dow 30, you want all ETFs, currency ETFs, futures, whatever, Russell, S&P 500, right? So all of them, and check your time frame. You can put parameters in as far as minimum price or minimum volume, etc., that sort of thing. And you can also select what are you looking for, long setups, short setups, or all of these, right? And then you click scan, and it's going to immediately populate your trade candidates. Click on one, and there's the chart, right? So again, very, very simple. This one has a lot of other tools as well in here, some unique tools that are only available on this platform, like a seasonality tool, for example, where it tells you, it gives you a bit of a history on that stock. So if you look at this from the year 2000, so basically going back 19 years, right? If you look at the month of April, 80% of the time from the year 2000 until today, so over the last 19 years, 80% of the time during the month of April, American Express has seen an increase of about 8.3% on average, right? So that gives you a high probability, even before you place a trade. So think about it. Remember when I said before, don't ask why, ask what is happening, right? So if we know that usually 80% of the time during the month of April, American Express has an up move, right? A significant one, on average 8.3%. Wouldn't it be great to just make a note of that in our journal, just ahead of, say, in late March, to start looking for a proper setup on American Express, right? For that month, and buying in ahead of that move? That'd be amazing, right? If we look at, say, a McDonald's, right? Well, look at November, right? You can look at March, April, and November. 85% of the time over the past 19 years, it's seen an up move on average of 2.5%, right? So all these tools give you an edge with that, right? It's a starting point. And of course you can scan for it too. This has a scanner on the right-hand side. So we bring up our seasonality scanner. Say we want to scan all the symbols in the S&P 500, and we want, a minimum growth rate of 75%, average move a minimum of 2% during the month of what's coming up next. Let's go to January, right? So let's see, since we're in December, what's coming up in January. And we'll go back as far as 1990. Hit scan, and you can see the line here. It's working its magic, and it's coming up with the moves. So if you look at QRVO here, 80% of the time, right? There's a move. Let's click on that chart and look at January. Now, this has limited history. It's only 2015. It's only 4 years. So you could say, well, that's not enough history to go by. Well, Google has a lot more history, right? Going back to, I guess 2014. It must be longer than that. No, I guess 2014. But January, average of 5% move 80% of the time. What about Chipotle? There we go, 1990, Chipotle. Look at that. And even though January might not be, it's still good, 79%, 2.6%, but look at March, right? 86% of the time, a move on average of 7.6%. These are things you want to jot down in your journal. And so as you compile a list like that, as you head into every month, you'll have a number of candidates to already consider, right? If you're into trading earnings, this has an earnings tab that will show you the breakdown of how it's performed at earnings season, starting 2 weeks before, 10 days before, a day before, and so on. The day after, 3 days after, 5 days after, a week after, by quarter. So you can do all that analysis. All these tools are available here. If you want to, if you follow certain candlestick patterns, right? This tool will identify the different candlestick patterns. So you can go in and say, I only want to look for, like you can scan and say, out of the stocks on the NASDAQ 100, I only want to look for bullish engulfing, for example, right? Click scan, and it'll identify those for you. If you're into Fibonacci's, right? It'll automatically paint your Fibonacci retracements for the most recent setup, right? All of that is here. And Elliott waves as well. And there's scanners for everything. So there's the Veracity system, which has a scanner, our winning momentum strategy setup, which has a scanner. It's all there. And you can create your own templates. So there's our winning momentum strategy template, etc. And put the symbols on and go from there. So, there's a lot you can do. It all depends on how much time you have to devote to your trading and how much assistance you're looking for. Remember, with that package that we've put together, you're going to get the Veracity indicator, your choice of platform, whether you want Metastock or you want Tactical Trader, along with all the other courses that we have and everything else. We'll recap it for you soon, but let's see, any questions? Let's see. I don't know, again, who it is. Someone from Los Angeles asking for Elliott waves. Let's see, let me put them Elliott waves here. Maybe I should change my... So there, it draws in the Elliott waves. So the 1, 2, 3, etc. It'll draw them in for you. There, that's what it looks like. But, like I said, there's numerous tools here. You can also set up your own watch list here very easily, especially when you scan for a stock. So like these are scan results down here. If you look, when I hover over, there's a little star at the far right. If I were to click that, it automatically throws that symbol into my watch list. So, and all the usual tools that you would have on any other platform. So there's a lot there to go over, but thanks, Melanie, for your question. Any other questions on that?
Vince, I'm just going to go back and look through the emails on any questions that we may have forgotten about from the group.
Sure.
Just give me a moment here. Jerry was asking Vince, a suggested topic is a problem slash issue that I'm having. I'm an option swing trader. My time frame is 1 to 3 months. I use your system to choose a stock and feel confident about that. But the option selection is my issue. How to select the right option? Should I go in the money, out of the money, 1 month, 2 months, or more? Any guidance in this area would be greatly appreciated. The fact that he's a swing trader, does that change your opinion any?
No. Everything we've talked about earlier will answer that question. So, Jerry, if you aren't with us, I didn't see the name, but when you watch the recording here, you would have seen it. Hopefully, I've answered your question.
All right, John and Charlotte had also asked a detailed question. John, I hope the session or the various segments of the session have answered your question in detail. Bob was asking, Vince, what's your process? Pre-market, during market, and after market, and on the weekends for how you approach the market?
So really, these days, aside from running the scanners and just setting up my watch list, and what I showed you earlier on TradingView, where I have those green flag symbols and the red flag symbols prioritized there for the next trading day. That's really what I do. So I used to have a much more detailed process beforehand for prep before and after market. I don't have the need for that anymore. And it's not that I've gained experience. It's the fact that regardless of whatever news is going on, now that I've developed these strategies and have come to depend on them so much that it really doesn't matter what's going on. I mean, I still keep an ear on the news. I'll listen. I'll check the futures before market open to see what they're indicating as far as what kind of open we're going to happen. But honestly, I don't really worry about it too much. I strictly do my chart work, run my scanners, identify potential trade candidates, then compare them, identify the one or two that I'm interested most in, and then set a reminder. Market open the next day. I go in, I put my orders, fill out my trading journal, my spreadsheets, and then on a nightly basis, go back, review all the open trades, see if I need to make adjustments or not, and tweak the stop loss level, etc. Look if there's any news, and just more than anything, keep an eye on the earnings date. Make sure you don't get blindsided by that. But honestly, I think the less, I hate to say that the less thought you can put into it, the better, because you want to learn. But once you find a system or a strategy that works for you, it's just a matter of rinsing and repeating. Try to resist the urge of going outside that and doing too much more, because you really can get to the point where analysis paralysis takes over. So you want to just find that one method you're comfortable with, set up your spreadsheets and your watch list the way you're comfortable with, and then just get into that habit of consistency, that rinse and repeat method, day after day after day, and before you know it, the money will come.
All right, Abe had asked if the Tactical Trader platform is web-based. We've answered that. It is. Vince, we're just about 15 minutes to the hour. As always, we've gone over our allotment. Why don't we finish it off with your concluding comments? And a few folks were asking about if you can show the offer once again.
Sure, I will. I want to answer one question. Again, I'm not sure who this is. Someone from Los Angeles asking, when you're new to trading and there's so many strategies and tools out there, how do you avoid spending months and years studying and actually trying to use the ones that would create an income quickly? The best advice I could give you, because you will continue to learn. It's impossible not to spend months and years learning if you want to learn as much about it as possible. But the key is to keep it simple. So I know I showed you a lot of different things today, but something as simple as the pencil and ruler method, or that one moving average, start there, concentrate there, set up your journaling spreadsheets, your money management plan, your trading plan, right? Put it together and start trading it with a very small amount of money. You'll quickly realize what you're good at and what you're not so good at. And that's where you start making the tweaks. So don't worry about, all these fancy indicators and charting platforms. You don't have to go and spend all kinds of money, or like you say, months and years in school trying to learn it all. stick with the basics, start there, and then as you get comfortable with that and you realize what your shortcomings are or what you're really good at, then you kind of just go from one thing to the other. But the basics are always the best. So that's what I would start with. All right, let me bring up the offer here and run through it one more time. So
sorry, Vince, to get to it, it's tradingwins.com/all, ALL, as in all access.
Okay, let me type that in here. That way we have it. So tradingwins.com/all. There it is. So there's two packages. There's the all access monthly, and this includes the veracity indicator, which I showed you. Your choice, whether it is the tactical trader platform or the Metastock platform, along with every course that we have available in our store that we've taught in the past. You can access them all, along with our Pro monthly service, which includes the nightly videos, course of the month, our private Facebook group, our live market chats, which happen twice a week. And of course, you always have access to us via email as well for questions. So you get all of that. So basically everything we have for $297 a month, or the all access annual pass, which includes everything that you see here, including the veracity strategy indicator. But you also get an invite to the mid-year trading bootcamp that we have every year, and a 1-hour one-on-one consultation with myself. Here, let me elaborate a little. What I like to do with the consultations, it's more than a consultation. What happens is I ask you before we spend the hour together to send me a few of your trades. Now, whether they're real money trades or paper money trades that you followed in the past, I don't really care. I just want an honest reflection of what you've done, just a handful of trades, so I can tell quickly what it is that you're doing right and what it is that you're not doing right. And that'll give me a starting point when we meet. When we meet, I'm going to ask you a few background questions, try to figure out and assess what level you're at as a trader. And that way I know exactly where to take you or what to teach you to get you to the next level. And we'll maximize our time during that 1 hour. But my whole goal there, obviously, is to take your trading to the next level, depending on where you're starting from. And we can do a lot in an hour, so it's much more than a consultation. And so if you want to spend that hour with me and get everything else involved, veracity, all the courses, the pro service, the mid-year boot camp, everything, this is your all access pass annually, $19.97 a year.
OM is asking, do I need to have a TradingView subscription to use Veracity? No, you do not. You can simply use that tactical trader platform. Kathy from New Jersey was asking what other courses are included. I'm just going to run down the list. We've got the Forex Ninja training, the magic of penny stocks, collar trades, high octane options part 1, part 2, SuperConference 2018, high octane options, part 3, U10 strategy. We've got magic of moving averages. These will bring back some memories.
Yeah.
Protection strategies for today's markets. We've got hedging strategies and earnings season part 1 and part 2. We've got the 2017 SuperConference day 1 and day 2. Hedging strategies and earnings season. We've got the generating income from options, advanced technical analysis, day trading insights. What else do we have? Magic of chart patterns, magic of option spreads. Technically speaking, part 1, part 2, power of options, magic of Ichimoku, candlestick power, timeless technicals. Then do you remember any of these?
Yes, I do.
Fibonacci crash course, day trading crash course, and of course the one that started it all, 3 simple steps to profit.
I think the biggest benefit here is that they're all recorded and you can, pause, rewind, fast forward. You can watch them as many times as you want. So you can go at your own pace here. And like I said, the best thing to do is start with the basics, get familiar with that, and then go to the next step if you want to. So, you know, there are a ton of courses there that we've done over the years, and you have access to them all. More importantly, along with that, you know, comes the pro service where I send you a video every night of what happened in the market that day, share some trade ideas on those videos as well. We meet twice a week live, like in this environment, every Monday evening, every Thursday morning. Again, if you're working or have other commitments, you can't attend those live sessions. They are recorded, so you'll get the recording that you can watch afterwards. And so the main benefit there is the ongoing Q&A, right? If you have questions, let's say you watch one of these courses, you're not quite clear on something and you have a question, there's a format there, a platform for you to get your answer. Either show up live and ask your question, I'll go through it right then and there, or you can send me an email ahead of time. I will answer that question during the session and you can watch the recording afterwards, right? So we're here to support you along your way. You know, trading, like I say, always is a process. There's so much there. Best thing you can do is keep it simple to start, but you know, however deep you want to get into this, we're here to try to support you.
The marketing team, and by marketing team, I mean I forgot to add one part on the annual, is that you will get Vince's personal text number, so you can text him directly if you don't like email, and he will respond first opportunity he gets. Vince, did I forget anything?
No, I think we covered it all.
Okay.
You know, again, if there's questions after the fact, once we log off, you remember you can always send us an email, and we'll do our best to answer it. I don't know if Mark is on. Mark, if you are, I did
Mark
see.
from Pacific Palisades.
Yeah, I did see the email. I wish you all the best. I'm absolutely going to help you. I'm going to answer your question. We didn't have time during this session, but I will record a video separately that answers your question in detail and send that out to you. And that's over and above our session together, our 1 hour session. I'm not going to take time away from that for that. I'm more than happy to answer your question. So I'll send that out to you and we'll go from there. But I'll try to get that out as soon as possible. May take until Monday for me to do that, but I will definitely get back to you, okay?
All right, Vince, I'm going to turn my camera on for the goodbyes. I will see you here.
Let me do the same.
In just a moment, I'll wait for you to turn yours on as well. As you can see, we started from the morning and now it's getting a little darker. All right, Mark is on with us, and Mark says, thank you, you're the greatest. And Marlene was asking if I can give her a call tomorrow. Marlene, I will do that. Somebody was asking, and I can't tell who it was, does the monthly and annual include Tactical Trader website? Yes, it does. You'll have access to all of that stuff as well. Can we day trade and swing trade with this version of Veracity on Tactical Trader platform? Vince?
I'm sorry, can you repeat that?
Can we day trade and swing trade with this version of Veracity on Tactical Trader?
Oh, yes, absolutely. Any time frame, it really doesn't matter. It works the same across the board. So yes, you can.
Bob was asking how long is this offer for? Bob, you let us know when you want to take advantage of it. Thank you guys. That was a great seminar. Thank you for the kind words. I don't know who that is, but thank you for that. Is the question that Mark asked that the group might benefit from? Vince, I'll let you answer that.
It is. It has to do with the things you can do in advance to identify a stock that might have an implied volatility spike as they head into earnings. So you can know ahead of time, because the best time to pick those up is 2 to 3 weeks before the earnings event. And so I have covered it during one of our live market chats. I can do that again so everyone benefits from it. Mark, I'll still send you that video. But Yeah, I mean, unfortunately, we ran out of time here, but during one of our live market chats, I can absolutely go over that for the group.
All right, that was Spiros that said that was a wonderful webinar. Spiro, it's always a pleasure to have you with us. I know you'll be joining us on Monday. Fantastic webinar. Thank you, Vince. You are so generous with your time and knowledge of trading. Thank you for that. Russell asking, does the subscription include the Tactical Trader platform? Yes, it includes all of that stuff. Bob says, good point regarding options. I know guys who buy 2 to 3 weeks in front of EPS to capture eyeball increases. That was Mark's.
That's exactly what Mark was referring to, and not all stocks have that spike in implied volatility. There's a way that I do it through Thinkorswim. There's different ways, but yes, I will go through a couple of different methods for you.
Bob was asking, excuse me, Robert was asking, when do you think the recording of today's webinar will be ready? It should be ready by tomorrow, Monday at the latest. And Bob was asking, I already have access to a bunch of these courses. I love being able to go back and review them. One question, how does Vince decide? I think I'll use U10 strategy today or my favorite trade setup, or only do credit spreads today. Perhaps he could cover that later. And
sure.
Bob from Dallas had also asked a similar question. When you're looking at a trade, what goes through your mind? Maybe we can cover that on the Monday session at halftime.
Yeah, you know what might be a great idea? I think Robert mentioned it earlier on a comment is maybe I should pick a trade when I find something that I think I want to trade. Just go through the whole process from start to finish, what I'm thinking, what I'm looking at, how I'm going to set it up, and I can absolutely do that for the group.
All right, terrific, says Bob. Okay, we've answered that question. Okay, any question? Bob says, excellent job today, guys. Bob, I didn't really do a whole lot. Vince, it's all Vince. He's planned this whole thing, and it's hard to speak. He's been going since 10 o'clock with some breaks, and it's hard to go on for that long. And I know I certainly couldn't do just talking to a screen for that long. So Vince, you're a terrific instructor, and you have such a way with making these very complex concepts sound very simple.
Yeah, I'm just happy most of you stuck in the whole way. You stuck with us the whole day. I mean, and it's a Saturday. That's great. Thank you so much. I love doing this stuff. I have a passion for the markets, but over the last few years, I've really focused on teaching, and it's been great. And most of you are so loyal and have been with us for a while, and it's just a lot of fun. So we'll be back at it Monday night with another live chat. I hope most of you can join us then. And as always, bring your questions and we'll go from there. But no, I was happy to do it. So I really, more than anything, I hate seeing people get hurt by the markets. I think it's so unnecessary. And so I hope I've been able to, get across the point that this doesn't have to be as difficult as most people think, but more importantly, there are things you can do to protect yourself. And with what's coming down the pike here in 2020, at least I believe, is an event that's going to hurt a lot of people. But, if you're out in front of it, you can not only avoid getting hurt, you can actually profit from it. So I hope what I taught today got that point across.
Alan from Germany says, thanks for a great session, guys. Had a gallon of coffee ready here, but didn't need a drop of it. It was also exciting.
That's great.
All right. Will we get invited to the Monday night webinar? Yes, if you sign up for any of those offers. And if you're not currently a member, yes, you will. If you are a member, then you don't need to worry. You certainly will get invited as well. We'd love to get some feedback on it. Let us know how we did. If you can email us, info@tradingwins.com. and what we can do better next time and what we can do better for our mid-year trader bootcamp as well. Vince, another super conference in the books.
I know. I can't believe another year. Remember that first one?
I do remember the first one. It was at the MGM Grand.
Yes.
That was the first ever trader boot camp. Then we did the SuperConference at, I believe it was MGM again. Then we did Caesars. Then we did Four Seasons.
Right. I know the live ones are a lot of fun because you actually get to put a face to a name and meet everyone in person. But this way we get a lot more people from all over the world, and it's a much bigger impact. So
Yeah,
that's great.
I do recognize a lot of the names. Is there anyone other than Alan? Alan, I know, is from Germany. Is there anyone else that's here from not the United States?
Had a big turnout from the LA area this time, eh?
Mm-hmm. Spiro says, yes, this is a much better venue.
Yeah. Was it
All right,
from
we do have
Portugal?
one
Wow.
final giveaway before we go. This is for a $50 Amazon gift card, or you can choose a Kindle Fire. It's up to you. You let us know. The question is, which consumer brand has used the following taglines in its history? Life tastes good and make it real.
That's a good one.
You know what it is?
Robert's
says
quick.
Budweiser. It's not Budweiser.
Okay.
Any ideas for you, Mr. Moore? McDonald's is a great guess. It's not McDonald's. Tetley
No,
Tea.
I don't
A
remember
good
now.
guess from Robert. No, not Tetley Tea. Coca-Cola. Spiro comes up big.
There we go.
Coca-Cola.
Here's the winner.
When you think about it now, you remember all those taglines, right?
Yeah.
All right. This was great. Thank you for being here. 7 hours and 4 minutes now we're going on. We appreciate you. Thank you for, as I mentioned, taking these difficult concepts and turning them into bite-sized pieces for us that we can all digest.
We'll be back at it next year for sure. But before that, like I said, we'll have a video tomorrow for recap of Friday's trading and what to expect this week. And then again, hope to see you Monday night. But thanks again, everybody, for sticking with us all day. We'll get that recording together as soon as we can, but we really appreciate it. Thank you very much.
Thanks, folks. Have a terrific Sunday. We'll see you soon.
Take care.